point have cameras on the helmets of our officials. That didn't go over so well. But you know what? You've got to try things, and not all of them are going to be successful. You've got to have a little bit of failure to really be successful.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
At some point, you had to fight for the trademark, right, for the red sole.
Yeah.
Was that stressful?
Very stressful. Very stressful. Especially, you know, we are a small company in a way, and to have to fight people who have those huge companies who put you 27 lawyers on your back for something which is yours is very stressful. I mean, I wish I wish it didn't happen. Everything which happened to me is a lesson in a way, bad or good, and once it's done, and you're sort of happy. I'm happy about it. That thing I could have definitely avoided, but it's done.
Did you realize at the time when you started the company that you would become so successful and actually so big?
No. You know, when I started the company, I wanted to have a shop in Paris, which is my hometown, and I wanted to do pretty shoes for pretty girls. That was my goal.
And now you look back and you say, actually, I still make pretty shoes, but for many more women.
Yeah, absolutely.
Do you think you would have been so successful without the red sole?
I think the red sole definitely, of course, participates to my work, but also to the fame of my shoes, because it's instantly recognizable. But then, you know, the design is very important. But definitely, when you have such a strong sign of recognition, it participates to, yeah.
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet, with guests like U.S. Special Presidential Envoy for Climate Change, John Kerry.
Climate has no affiliation with any party or ideology. Listen to the scientists. This is not a matter of ideology. It's not a matter of politics. That's the challenge.
Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
DOJ or other authorities.
Could face bigger challenges.
Britain's next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is my kitchen table and also my filing system. Over much of the past 3 decades, I've been an investor. The highest calling of mankind, I've often thought, was private equity. And then I started interviewing.
While I watch your interview, because I know how to do some interviewing.
I've learned in doing my interviews how leaders make it to the top.
I asked him how much he wanted. He said $250. I said, fine. I didn't negotiate with him, and I did no due diligence.
I have something I'd like to sell, and how they stay there. You don't feel inadequate now because being only the second wealthiest man in the world, is that right?
A major trailblazer in the financial service system is Jane Fraser. 2 years ago, she became the CEO of Citi, and in doing so, became the first woman to head a major money center bank. Today, Citi and other major banks in the United States are facing challenges to the banking system. I sat down with Jane Fraser recently to talk about these and other challenges. Anything new in the banking world?
It's been a quiet week.
Quiet, okay.
Quiet week, David.
So let's talk about what has been going on. Let's start with the easy ones. Silicon Valley Bank. What went wrong there?
Well, before we dive into that, I've worked in financial markets all around the world, and I have have to say we're very lucky in America. This is the best financial system in the world. It is the envy of the world.
Okay? But despite it being the best, we have some problems from time to time.
Yeah, but they're isolated problems. So when you look at it, the financial systems is broad, it's deep here, it's competitive. We've got some large banks that are well capitalized and a source of strength at the moment. We have medium-sized banks, regional banks, and by and large, they are equally well capitalized, serving their communities, play an important part in the banking system. This is quite isolated.
Okay, but people are still interested in hearing about it. So, your bank is well capitalized. Your bank, I should have said, is a bank with about 230,000 employees.
Yep.
And about an $85 billion market capitalization. So your bank is in good shape, and your bank is the fourth biggest bank in the United States. Is that right? J.P. Morgan, Bank of America, Wells Fargo, and then Citi. There is a bank on the West Coast called Silicon Valley Bank, or there was a bank there, not as well capitalized. I mean, did the regulators not understand what was going on, or the people in the banking world, people like you, were you surprised by what happened?
So you had a combination of two pieces. You've had the macro and some idiosyncratic and factors around Silicon Valley Bank, but then you also had the impact accelerated by social media of what went down. And the rates curve and the increase in rates has been most we've seen, the fastest and the steepest in 40 years. So there's a bit of pain that comes from that. Secondly, you did have idiosyncratic factors, I think is the polite British way of describing them in Silicon Valley Bank. So as all this played out, you saw some pretty serious holes in their balance sheet management, and they had a very concentrated client base. And that client base ended up burning cash much faster than anticipated. And they ended up wanting to raise capital, and it went down pretty quick. In the Great Recession in 07, 08 or so, the U.S. government passed TARP legislation, and under the TARP legislation, large amounts of capital were injected into banks, including Citi, and effectively that meant that the shareholders, the creditors, and the depositors were all protected. This time around, Silicon Valley Bank was only the depositors were protected over a decision made by the Biden administration, others over the weekend. Do you think that was the right decision to protect only the depositors and say goodbye to the shareholders and goodbye to the creditors? I think it's very important to protect the depositors. Right now, the banking system everywhere around the world depends on confidence, and that confidence has to be in the safety and security of deposits. So in terms of the most important job here, they did the most important job, which is making sure the depositors were whole. So in the old days, when there were bank runs, you used to see people lined up outside the street and get their money out. Now, you just on your iPhone or whatever phone you have, you can take your money out. So money moves so quickly. Was that a factor as well in having the money get out of a bank so quickly? You don't have to wait in line. You can just do it over the... It is a complete game changer from what we've seen before, David. You're absolutely right. There were a couple of tweets, and then this thing went down much faster than has happened in history. And frankly, I think the regulators did a good job in responding very quickly, because normally you have longer to respond to this. So they acted with quite a lot of speed, given how quickly this happened. So some people say you have a moral hazard when you protect people. So by protecting all the depositors in Silicon Valley Bank, the implication was that if somebody else has a problem, we'll protect them and so forth. And so the $250,000 limit is meaningless, more or less. Or do you think the Federal Reserve and the Secretary of Treasury are saying we're not going to protect every depositor, or we're going to protect certain depositors? I don't think they need to go out right now, because the banking system is pretty sound, and we're talking about a few banks. We heard it from the Chairman Powell today. This is not something that is spread across the entire banking system. This isn't like it was last time. This is not a credit crisis. This is a situation where it's a few banks that have some problems, and it's better to make sure that we nip that in the bud. Not to pick on the West Coast, but there's another West Coast bank, First Republic Bank, which is around the country, but based in San Francisco, and they've had some problems. They've had gigantic decline in their market value and so forth. Do you expect that somebody will bail them out or buy them? Well, I'm not going to comment in depth on First Republic, because they are actively working through the challenges that they're facing right now. What you saw last week was a number of the large banks, 11 of us, got together to put a large capital or deposit injection into them to help buy the time to make sure that they could come up with the right solution for the restructuring that's needed.
So the large banks and others put in roughly $30 billion of deposits.
Yeah.
I think you put in roughly $5 billion or something like that. So how did that happen? Did Jamie Dimon call you up and say, hey, you have $5 billion you don't really need, and you can put it in First Republic? And is that you have to go to your board to say, I need to get $5 billion somewhere? I mean, how do you make that decision? And was it, you say to Jamie, I'll call you back, I'll think about it, or how does that work?
So one of the great things about this was actually that the banks did all come back together, because you think of it, we're all we usually try and kill each other in different deals that we're trying to do. So there's a lot of competition between us. But in this instance, this is one where we're in a strong position. We want to stop what could have been a problem. And we all know when there is a confidence crisis, the logic that takes over isn't necessarily rational. So we wanted to go and help protect the system. It's in the interest to do so. So despite this being quite a divisive environment that we're all operating in, this is an instance of the banks coming together and saying, okay, what can we do here to support a system that we have confidence in? And you don't put $5 billion into the system through the generosity of your own heart. You do it because you have confidence in the system itself.
You expect to get that money back eventually?
Yes.
Okay. So Jamie Dimon is a great banker. I think he's been the head of J.P. Morgan for 17 years, something like that. Jamie Dimon. Well regarded. But why do you think it is the case that he's calling around and doing this and not the Secretary of Treasury, the Chairman of the Federal Reserve, the head of the FDIC? Why is it a non-government person is doing this? I would have thought a government person would do this.
David, why do you think that Janet wasn't calling around doing it? Do you believe everything you read in the newspapers on these ones?
Because when people in Washington do something good, they usually have the press know about it. So, but maybe she was calling around. I'm sure she was. But Jamie seems to be getting all the credit, if credit is the right word, or is that not fair to give him the credit?
Oh, Jamie played a role. I think we all played a role, and so did.
Okay.
There was a very active discussion over that weekend.
Would Citi consider buying First Republic, or you're not interested?
No.
No, you're not buying. Okay. Another bank called Credit Suisse. Credit Suisse seemed to dissolve very, very quickly. Were you surprised at how quickly that bank kind of went away after about 100 years of being around?
So the nice thing is we're talking about 3 or 4 banks out of the thousands that are here in the States and the rest of it. So let's put that in perspective. So Credit Suisse, I don't think anyone was falling off their chair that Credit Suisse ultimately ended up where it did. It was really a question of time. It's been a troubled institution for a long time. Those of you who don't know it, it's a very global bank. In it's got a very strong operation in Switzerland, good wealth management in Asia, an investment bank here in the States and around the world, but it's had a lot of issues. It's had a lot of management instability. It's had a number of different crises and things that have hit it.
Well, Credit Suisse has some great private bankers, and they have some great clients. Are the Citi bankers calling up the Credit Suisse former employees and saying you should come here now, or something like that?
No, I think they're calling us.
They are, okay. All right, okay. So when you went to Harvard Business School, you entered in 92, something like that?
Yes, that's right.
You entered in 92. Were there a lot of women in your class then?
Probably about 24, 25%, something like that. Yes.
And
there were enough of us to cause trouble.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
up, what did you say you wanted to be? The CEO of Citi when you were growing up? What did you think you wanted to be?
I wanted to be a doctor when I grew up, but I was really lousy at biology, so that kind of knew that one
That
ended
happens
quickly.
a lot to people who want to go to medical school. So, okay, you grew up in Edinburgh area?
Yep, I did.
And were your parents bankers?
No, definitely not. So my father was a Scottish accountant, which meant you're not really relying on parental generosity and extra pocket money from a Scottish accountant as a father. So I used to earn my pocket money on the golf course at St Andrews caddying. You would not know it from my golf game, but...
Well, I'm sure it's better than mine. So you went to Cambridge. After you graduated, what did you do?
After I graduated, I joined Goldman as an analyst.
And that's an easy job to get, and an easy job when you have it. You don't work more than 30, 40 hours a week.
Yes, yes.
So how many years did you do that?
So I worked at Goldman for a couple of years, and I was young when I started, and I was the boring girl from Scotland. Everyone else was European, spoke multiple languages, and was a lot more exotic and interesting than me. So after I finished the analyst program, I thought I'd better make myself a bit more interesting, so I moved to Spain. And,
did you speak Spanish before?
I didn't.
So now you speak Spanish?
Sí, hablo español perfectamente. Sí.
Hey.
¿Qué tal su español?
Well, I know one word, maybe C or something like that. I don't know.
I thought it was cerveza. Yes.
So my language skills are very limited. So
luckily you have other talents though, which is a fortunate
Spanish
thing.
Isn't one of them, but so you do there for a couple of years, and then you decide to go where?
To America.
All right, and where did you want to go in America?
So I did the same again, taught my way into Harvard Business School, and I was fascinated by the American machine. And if you've spent a bit of time in Europe and grown up in the 80s, 70s, and 80s, it's fascinating. America is just something you want to try and understand, and the American economy and the American entrepreneurs, not someone you ever want to bet against.
So when you went to Harvard Business School, you entered in 92, something like that?
Yes, that's right.
You entered in 92. Were there a lot of women in your class?
Probably about 24, 25%, something like that. Yes.
And
there were enough of us to cause trouble.
All right, you graduate from Harvard Business School, and then you decide to go to McKinsey?
Yes, I did.
And why did you want to be a consultant?
Well, first of all, was why didn't I go back into banking at that time? And I've been in banking in the 80s where there weren't many women in banking, unlike the business school. They wore suits with very big shoulder pads, and they were more scary than the men. You remember the era. And so when I looked at the consulting, particularly McKinsey, I like partnerships. I think partnerships are great places to grow up. The apprenticeship model is wonderful. Global institution and firm. And also it was quite strategic in what they were looking at. It was similar issues to M&A at Goldman. But I thought I would have a chance of having a family, a bit more predictability in the work schedule.
So you did it for 10 years, roughly?
10 years, yeah.
And you had 2 children during that time?
Yeah.
So
Yep.
you go to McKinsey, you work your way up, you become a partner there.
Yeah.
And, being a partner in McKinsey is a great job. Why did you decide to leave to go to Citi?
Yeah. I became a mum at the same time as I became a partner. And I worked part-time all the way through my partnership years. And McKinsey was fantastic about that because I was able to spend time with kids before they went into school. But then when they were then at school, that I felt like, okay, I can go back full-time working again. And I honestly, I felt like it was time that I could prove that I could do it rather than just advise.
All right, so you went to Citi. At the time, did you think a woman could become or would ever become the head of Citi?
I honestly never thought about it. At that point, it's a firm that there were quite a few women around in. I'd been in an environment that was always very supportive around it, some fantastic male mentors and others. And it was just never something I thought about. This was 20 years ago.
So
I was just enjoying the day job.
So you had a series of jobs. Every one, you were the CEO of this division or that division and so forth. And one time they asked you to move to Latin America to be the CEO of Latin America. Did you think that was a dead end? You're going to move to Latin America, get out of the way of the succession, or did you think that was a way to get promoted?
It was a big turnaround role, and it's one of those ones you say, if I did a good job, then that was going to put me in good position for bigger opportunities ahead. And if I did a bad job, then so be it.
You weren't afraid they would forget you. You're down in Brazil or something, and you weren't afraid they would forget you and everything like that?
No.
Okay, so you did a good job. You come back, and you're the head of the Global Consumer Bank. What is the Global Consumer Bank at Citi?
So that's retail banking. That's a credit card, which I believe you are a proud owner of a Citi credit card, David.
I am. I do have that here. I can't. I'm getting. I don't have enough frequent flyer miles on it, though. I'm trying to. You told me I'm not qualified for my frequent flyer miles, but
yeah, you got the wrong card.
Is it a? Is this the best credit card you can get?
So, David, you have the one with our wonderful partner, American Airlines, and they're
how come
it's a 35-year partnership.
But yours is black. How come mine's gold? How come I don't have?
Yeah,
which is better?
You've got to ask for it, David.
Oh, okay.
Yes.
All right. Well,
although I suspect you may not be flying quite as much on the commercial airlines.
Yeah.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How do Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
When did you realize for the first time I could be, or you could be, the CEO of the bank? I mean, there are a lot of people. You have 230,000 employees. A lot of them want to be CEO. When did you realize for the first time you had a chance to get that?
When I was made president of the bank, because up until then you don't really have a sense. But that was the point when Mike and John had a conversation about being a likely successor, but no guarantees in life, and I better do a good job.
Okay, so your predecessor was Michael Corbett.
Yeah.
He retired about 2 years ago.
Yep.
You succeeded him. What was the biggest challenge you had in becoming the CEO right away?
It was COVID. So this was becoming CEO during COVID is not the easiest because one's used to going around, going to different sites, seeing our people, seeing our clients in person. And while Zoom did an amazing job, it is not the same. And so you have to learn how to lead in a different way.
Today, Citi is a bank that has announced it's changing its strategy.
Yes.
And you now want to be a consumer and institutional bank in the United States. Is that right? And you're getting out of the consumer business outside of the United States.
So what we've said we are, rather than what we're not, is it's a pretty extraordinary bank in its history and in its presence globally. It's uniquely opens the door as a bank in 100 different countries. So the city is to be the preeminent banking partner for companies and for investors and for individuals with cross-border needs. And that's the vision of the bank. We will serve that client base as their absolutely critical partner.
Okay, so you've sold a number of your international consumer businesses, and
Yes,
you've announced you're trying to sell your business in Mexico.
The consumer business.
Consumer business.
Yes.
Who are you going to sell that to?
Oh, we've been fortunate to have a lot of interest there. Look, we looked at consumer banking, and we could see that originally the view had been that you would get a lot of global scale in consumer banking, and we were very strong in a number of different geographies. But the reality is you don't get as much scale globally. It's much more about local scale in those businesses. So we decided, let's focus. We want the bank to be simple. We want to be truly excellent at what we do. And that's better if you're a more focused bank around fewer business lines. So that's the path we're on.
So the bank stock under your predecessors and to some extent under you hasn't really moved in 10 years. Is that a concern?
Well, we're transforming the bank to make sure that we're in a very different position. So we're changing the strategy of the bank, as we talked about, and that entails selling 65,000 employees. It's 25% of our employee base. So we can really focus and double down on the businesses that make sense.
Of the 230,000 you have, you're selling 65,000?
Yes.
Oh, wow.
Yes, it's a lot. And I think it's under the belief that where we truly excel, we will move every single day $4 trillion of volume for 5,000 multinational firms. And there's no other bank in the world that can do that. That's an incredible asset for America. It's a strategic asset for the States because you'd much rather have American companies operating on American banking rails and not foreign banking rails, particularly these days. So that's what we're focusing the bank around, is that client base. And it's a big transformation, David, right? This is bold. This takes some courage to do. We're making really good progress on it. And we're putting a lot of investment into modernizing the bank because we've had some regulatory orders against us as well to make sure that we make the investments we need to, and making sure the culture is there of real excellence, but also to be a human bank. We've talked about that being important. Put all of that together, that's a lot of transformation, it's a lot of work, but we're determined around it, and we're completely convinced that that puts the bank into a different profitability, different return profile, and ultimately the benefit of our shareholders.
Suppose I'm listening to what you say, and I say, she's obviously articulate, she's committed, maybe I'll buy her stock. You think your stock's a good buy right now?
Yes.
Okay.
Very.
If I buy it, I can get an appreciation of some percent I can be happy with, you think? Not as good as private equity returns, but good, right? For young professionals, why should they want to work in a large commercial bank? What's the appeal of it? Why, if somebody goes to Harvard Business School, why not go to a private equity firm, a hedge firm, one of these, important organizations? And how do you recruit people into a place like Citi? What is it that you say is so great about being a commercial banker?
America's global banks are right in the center of some of the biggest challenges that are going on in the world. Geopolitically, we get pulled into the conversations. We're playing a critical role in supporting clients and countries. And you get an opportunity to come and work and learn in a team environment, in an apprenticeship model on how to tackle and solve some of these pieces.
What do you do for relaxation to get away from the office from time to time? Are you a golfer or something?
Yeah, well, look, I love spending time with my kids. So, being able to have a chance to spend some time with them. They're less enthusiastic now than they used to be when they're little about that, but I'll take what I get.
Do they tell their friends who you are, or they don't want to tell?
Oh, so when I was announced as CEO, I knew it was going to happen. I called up my Duke son, and I said, didn't pick up, as usual. I said, please call me. And I get a text back.
You called your son and he didn't pick up?
No, didn't pick up. He sent a message about, I'm busy. I said, no, please, I've got some news. Could you pick up? And he's like, Mum, I'm on Zoom calls. I'm really busy. And he did not pick up. I ended up having to text him the next morning that it was going to be announced. And then he came back to me at the end of the day and said, Mum, it was a text message, it wasn't a call. I said, Mum, you're all over the news today. Are you important or something? ...
We don't have enough women founders, CEOs who are getting funding. So basically less than 2% of VC funds go to women, less than 1% go to women of color. And so in this innovation space, I said to myself, what's the best way to use capital to move things for women? And that's when I started to say, okay, I actually need to move some money into the venture capital space, and I want to do it smartly. I mean, the first goal is to make money. I'm not putting my money out as a social impact. I'm putting it out to make money. But I wanted to go behind funds like Aspect Ventures that's run by Teresa Gao and Jennifer Fonstadt, who are looking at these opportunities, and they have a thesis around, my gosh, there are so many opportunities there if we go towards funding some of these women businesses.
Some LPs have said to me, all we care about is returns. Some of the best investors may not be the best people, but they have the best returns. What do you have to say to those people?
I have to say you're investing in what you know. And so you need to look at what trends are coming in the nation and how you're going to address them. Women are 85% of consumer dollars spent. Women control 70% of financial decisions in the house. So if you're not investing in products that go towards females or a women-led company, you're missing an opportunity because you just don't see it.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
I think inflation is continuing to melt, which will allow the Fed to eventually ease.
Inflation might not be as big of a problem if we get into a recession. I think the recession will do the job.
If something bigger breaks and a crisis supersedes inflation for the short term, that could lead them to cut.
The trouble will come in the second half when we then are actually facing much higher growth expectations.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
What are we doing here? What are we doing here?
Lisa pulled the short straw. She's wearing the Easter Bunny outfit.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Counting you down to the payrolls report, 90 minutes away. Tom, that estimate was about 240. It's come down to about 230 over the last couple of days after a series of data misses so far this week.
No superlative, but this is one of those jobs report where things have changed dramatically in one day. Things have changed dramatically across 4 or 5 days. It's a different jobs report than what we were thinking about on Monday, and it's all about what Ellen Zentner is going to talk about, which is a slowing American economy.
I'd say it's all about the data we've had so far this week. If you look at the activity data, the ISMs, manufacturing services, downside surprises. If you look at the ADP report, downside surprise, and claims yesterday, Tom, the wrong kind of upside surprise.
Yeah.
Jobless claims starting to leak just a little bit higher.
Stephen Stanley, who Mike McKee adores, Stephen Stanley really, I thought, was Santander, was really quite good about the nuances of claims where they made adjustments, and it was worse, but he's unsure how worse it was, and as anybody in economics, he needs to see more data, migrating up to 220, and dare I say some modeling out to 240. I believe Goldman Sachs was there in my travels.
I'd go back a year. Tom, I went through the data this morning. I had to go all the way back to the March report delivered in early April for the last time we had a downside surprise on a payrolls report. It's been upside surprise for the best part of 12 months.
What we're going to do today, folks, in this special edition of Bloomberg Surveillance with some wonderful guests to give you perspective, is sort of frame out not so much this jobs day, but the entirety of it for America, and frankly, linking it into the worldwide view as well. With Dr. Alarian with us here later, and with talking to the managing director yesterday, it'll be great to get a global GDP view on that. John, let me review that. That made headlines yesterday before we get to the data, and it's just simple. I've never seen this in umpteen years of studying international economics. The IMF went from 3.8% is a 5-year view, John, per year, down to 3% growth over 5 years, per year, over 5 years. And the answer is I've never seen that.
So weakest growth profile since the 90s. Is that right?
33 years.
Wow.
33. Wow. It's a wow statistic, and somewhat courageous given the way the IMF's getting beaten around.
And
right
China
now.
and the reopening is not going to bail us out. We just go back to trend after
Yeah,
a
I
year
think
of
that's
reopening.
been a shift in the last 30 days as we've gone from whoop-de-doo 5%, 6% GDP to we're not sure.
We've got to compare and contrast the views on the Federal Reserve as well. Jim Bernard of the St. Louis Fed yesterday, seemingly suggesting, Tom, that perhaps we've seen the worst of it in the banking sector. He went on to say this, and I found this peculiar compared to what I've heard from other people. It's a good moment to continue the fight against inflation and try to get on that disinflationary path. On the same day we heard that from Jim Bullard of the St. Louis Fed, we heard this from Torsten Slok of Apollo, who we caught up with yesterday. Tom, he said quite simply, the credit crunch has started. And I said to Torsten yesterday, I said, Torsten, do you believe the last hike was the final hike of this hiking cycle? He said yes. He thinks that's it. The Fed is done.
The history of this, and we're not going to do fancy charts today. We're chart free today on Bloomberg Surveillance. Is recessions come quickly, slowdowns come quickly. They're not like a gradual slope on a chart, folks. It goes straight down, and that's maybe where we are right now.
Let's give you a snapshot of the markets. Equity futures are open. Equity futures not doing much. Positive, then negative by about 0.1% on the S&P 500.
Are they trading?
Totally unchanged on the Nasdaq. Equity futures are trading, Tom. Cash bonds, treasuries, they open in about 56 minutes
I
time.
have comfit here. Bitcoin's
24/7 all the time.
24/7 all the time.
Doesn't celebrate religious holidays.
It's a religious.
No days off.
It's a religious experience in its own. Just under 28,000 on BitDog.
Thanks for that. Your estimate today, if you are just tuning in, welcome to the program. The payrolls report comes out in about 90 minutes from now. We're looking for something in and around 230,000, according to our survey. Joining us now to discuss is Priya Misra, the head of global rate strategy at TD Securities. Priya, let's start there, and welcome to the program. Just wonderful to do this with you. Priya, what are you and the team looking for in about an hour and 30 minutes?
So we're looking for another strong report. 270,000 is our forecast, 0.3 on wages, participation slightly ticking higher. So, we're very concerned about the hard landing, but later this year, we don't think that this report is going to show it because all the high frequency data of small business hiring is still strong. So we're looking for another strong report. I'm not sure it matters a whole lot for the market. I think the market reaction will be highly asymmetric. If we're wrong and we get a slight miss, I think the market reacts a lot more than essentially if we get a strong report.
So, Priya, basically what we're going to do is discount anything that says this economy is okay and embrace anything that says this economy isn't doing well.
I think so. I think, partly the data that we're looking at is responding to monetary policy 6 months ago. And it's absolutely not responding to the banking crisis that that we're going through. So I would argue the data's lagged. The market's already kind of nervous about, are we at the end of the cycle? When does the cycle turn? When does the Fed start to cut rates? Market's forward looking. What we're getting is highly lagged data. So I think the market's going to be a lot more sensitive to any weakness right now is probably telling you that the economy is was already slowing going into the banking crisis. So I think that's why the market's going to react a lot more. We saw that this week. ISM jolts, I think we saw significant reactions to these downside surprise. Now, we're not looking for that downside surprise, but if we do get that, and we could get that in wages is notoriously hard and extremely volatile on a month-over-month basis. Remember last month, we got a slight miss on wages, and the 2-year moved 30 basis points on that day. And then today's also sort of short day. So we could get a pretty big reaction.
Priya, I think Zero Hedge featured it. I'll give them credit. But they mentioned that Jerome Powell looks at the short-term space away from the 2s10s. And he's looking maybe at a 3-month T-bill and then the same guesstimate of a 3-month T-bill 18 months from now. Explain to our audience what the chairman's looking at there, looking at 90-day full faith and credit paper, and then the guesstimate of the market out a year and a half.
Sure. So I think what a lot of Fed officials, us included, we look at, is the market pricing in rate cuts in the very near term? Because that would be a sign that policy is restrictive. The market expects that the economic outlook is going to worsen and the Fed is going to have to cut rates. That signal has been inverted for a while, meaning the market saying that front-end rates are extremely high. The Fed's going to have to cut rates. I think the market right now is pricing in the first 25 basis point cut by September. There was a time earlier this week that was being priced for June, July. So I would say that, I disagree a little bit with how quickly these cuts are being priced in. But if you look at the total amount of cuts, we're not pricing in that much in cuts. The Fed funds rate at the end of next year is priced to be 275. That's not recession in my mind. We get a recession, the Fed's getting a lot below 275.
So to speculate and to game the guess, what does TD Securities recommend? Are you buying 30-year zero coupon bonds? Are you working in the short-term space? Where's the place to guesstimate on the Priya Misra bet?
So we've been long 10s. It's more of a risk-reward view. In hindsight, over the last week, I should have been long 2s rather than 10s because that front end's moved a lot more. But if the data is okay, I think the market can actually push out the timing of the first cut. So it might be safer to be in 5-year or 10-year. You talk about 30-year zero coupon. That's a pretty high conviction view that we're heading into a recession right this second. So I would rather be a little bit in the curve. But being in the very front end, it's a great trade right now. If you're buying 5% bills, that's great. But what are you doing 6 months from now when the Fed starts to cut rates, or a year from now when Fed funds is at 2%? So when I think about reinvestment risk, I think the very front end, it's a great short-term liquidity play, but it's not a play for over the next 2 years. I would say the 5-year or the 10-year. We've been long 10s. I would say being long 5s is also attractive. You're not positioning for when the Fed starts to cut rates. You're positioning for, number one, a hedge to risk assets. Number two, that the Fed is going to cut a lot more than what is priced in. Whenever they start to cut, we can debate that. Yeah. But I think they're going to cut much more because they'll want to be in accommodative territory. I'm thinking 1%, 2%, that's not 3%. We know 3% is high Fed funds. So I think they'll have to go much below that.
Priya, that's against the consensus because some people think we stop at 3. Here's the communication we've had so far from the Federal Reserve. Priya, Jim Bullard yesterday, I found some of this slightly confusing. He said the following, that continued appropriate macroprudential policy can contain financial stress. Then went on to say, while appropriate monetary policy can continue to put downward pressure on inflation. Isn't that contradicted by the fact that they've told us in the last month that financial stress is a substitute for rate hikes?
I think it depends on how is that financial stress manifesting itself. If it is tightening in financial conditions, if it is tightening in lending standards, I absolutely think that that is a substitute for rate hikes. If it is just liquidity concerns and the banks need liquidity, I think at that point the Fed can try and sort of disentangle, financial crisis management from monetary policy. I think right now we don't know, but our view is that this liquidity banking crisis is morphing into a capital crisis. It's not something I think we'll see right away, but banks tighten lending standards, bank net interest margins are going to be under pressure. They're going, if bank lending slows down at precisely the same time as the consumer savings buffer goes down, that's what sort of supercharges the weakness. So at that point, I think the Fed will need monetary policy. I think trying to separate the two is actually dangerous. But I think the Fed will need to see actual data. The one big difference I think we all have to get used to, the Fed reaction function is going to be a lot more reactive than preemptive because of inflation. So I think we're going to have to see it in the data, in the jobs data, in the consumer spending data, for the Fed to say, okay, we need to use monetary policy. I think right now we're not there. So, which is why I think that curve that I know you're going to ask me about, which has steepened, I think it's hard for it to keep steepening until the Fed actually says, yes, we're about to use monetary policy. And I think today's data is not going to give them that. They're going to need to see the unemployment rate getting, north of 4%, 4.5%. And we're very far from that. For them to say, okay, we're sort of done, we're getting ready to ease. That's when that curve's going to steepen a lot.
Priya, you teed up the next segment, so we'll pick up on the yield curve in just a moment. Priya Misra there of TD Securities is going to stick with us. Tom, just some tension there between the market view at the moment, which is pricing a disinflationary bust perhaps in the bond market, and then the view of some Fed officials out there speaking at the moment.
It's all coming at us and at the governors, the presidents, and the chairman and vice chair is in lightning speed in is April. And I would dovetail it into, as Priya said, the capital issue moving from liquidity issue. Where do you see that? A single sentence from the managing director yesterday on commercial real estate. Why is the IMF talking about commercial real estate?
Yeah.
That's why.
I keep going back to the calendar. Payrolls in about 1 hour and 20 minutes. Then on to April 12th CPI. Back end of next week, some bank earnings. Priya Misra is going to stick with us from TD. That's up next. And a little bit later, Tom, 8 o'clock, we'll catch up with Mohammed Al-Arian around this table.
A little bit later, Tiger Woods tees up at 12:54 p.m. There you go, round 2.
You need to know about Victor Hovland, okay?
I know, he's doing well.
He's doing better than well. Absolutely killing it. Playing alongside Tiger, who's not playing so well.
But come on, birdies on the 15 and 16. This is Tiger's day.
Are we doing Masters coverage today?
Not with me or not. That would be a
future.
Could you
down
see the two of us at the Masters?
About 1/10 of 1%. We should make that happen next year. So it's very relaxing.
We could do the jobs report with a little
You'd have to be
binocular
quiet.
thingy.
Could you manage that? You'd have to be quiet.
I'd have to put a cork.
Can you manage
the Masters
that?
cork, it's green in my mouth.
Can't get that picture out of my head. Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Secretary of State Antony Blinken says China wants to have it both ways when it comes to the war in Ukraine. In an interview with the European news network Euronews, Blinken said China is trying to advance a ceasefire proposal while also backing Russian President Vladimir Putin. He added China should be focused on urging Russia to respect Ukraine's sovereignty and to give back to the territory it has seized by force. Israel strikes back after the most sustained barrage of rockets launched from Lebanon and Gaza in 17 years. Israeli jets bombed Hamas sites in the Gaza Strip early Friday, causing property damage but no injuries, according to Hamas officials. Israel targeted underground tunnels and sites used for weapons production. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Next week, Surveillance is live from Washington, D.C. as part of Bloomberg's extended daily coverage of the World Bank Group and International Monetary Fund's spring meetings.
These meetings, even with the banking crisis in place, are really, really important.
Economic outlook, poverty eradication, aid effectiveness, and more.
How slow could global growth get?
You could have a global recession. Live coverage throughout the day starts April 11th on Bloomberg, your global business authority.
I think the inflation might not be as big of a problem if we get into a recession. I think the recession will do the job. Now, that was not the plan of the Fed. It was a soft landing, not crashing the banking sector. But that's a part that they should have seen. I think there was a regulatory failure, and the Fed needs to own it and change.
Luigi Zingales, the professor of finance at the University of Chicago, just absolutely fantastic yesterday. Tommy had this to say: in the last 2 years, the Fed has failed twice. It has failed to see inflation coming. It has failed to see the banking crisis coming. Really brutal stuff.
It is. A nation needs a trustworthy Fed to combat inflation, and on we go. And this is the trust question that's out there with Dr. Larian helping later. Zingales wrote a book that I featured a couple years ago now, actually, John, 11 years ago, A Capitalism for the People, and that's what Professor Zingales is screaming about, is this idea that they got to get capitalism and, frankly, a Fed policy around it's more nimble for the people. And the storm clouds of the last 5 or 6 days is really the first, I would call it, direct emotion that Jerome Powell has to face of slowdown.
I imagine Mohammed's going to have some things to say about this. Mohammed El-Erian's joining us a little bit later this morning in about 43 minutes' time, about 40 minutes' time. Looking forward to that conversation. About an hour from now, an hour and 12 minutes, we'll have the payrolls report. The estimate at the start of the week was something close to 240. Just had a series of data misses so far this week. That estimate has come down just a little bit, Tom, to about 230.
It's come down to 230, and what's far more is I think, is we heard from Priya Misra, and she joins us here in a moment, is a wage dynamic. And it's going to be the dovetail of this. And what it does really, John, is add to each and every data point you see. And I'm going to go back to the 60,000-foot view from the IMF of global slowdown. And now, as you mentioned, every tea leaf this week is indicated an American slowdown. Is Atlanta GDP now is solidly under 3%.
Priya Misra, still with us of TD Securities. Priya, let's start there with the bond market, with the yield curve. You made a wonderful call in the last 12 months. You were talking up -50, -60. We got to -110. Priya, only a number of weeks ago. What's the call on the curve now?
So I have to say I'm somewhat neutral here on the curve. I prefer duration risk over curve risk, because here's the problem. The slowdown that we're seeing in the economy, that is an intended consequence of rate hikes. But slowdowns never happen gradually. If we're heading into a recession, there's going to be a really sharp deceleration. The Fed's going to have to respond. The curve will likely then steepen. And, the curve typically moves 100, 200 basis points. So, we've steepened a little bit. I would say into today, we can actually expect a little bit of flattening because, we're still looking for a strong report. But if the economy is indeed turning, if the bank crisis, which in our view is already morphed into a capital crisis, if that's resulting in a decline in lending standards, the curve can steepen. Instead of trading the curve, I'm actually long duration. I think 5s and 10s are a better place to park your money than trading the curve, because I think it's going to be asymmetric. Rates can fall a lot more. How much more do they rise? I think the curve is a lot more symmetric, meaning it can flatten back to the lows if the economy is okay and we can sort of go back to where we were earlier in the year, or it can steepen 100 basis points if the Fed is about to start to cut rates. So I think it's a very, very tricky on the curve. I would not really, put a lot of chips on the curve here.
Priya, your view on the Federal Reserve is all about the seat that you sit in. For the markets, they're going to be proactive and price in a lot of this up front. You said something about the Fed being increasingly reactive. So for the market, there's this belief now this economy is just going to turn over. Ignore the good data, focus on the bad stuff. For the Fed, it feels like it's going to be the other way around. So Priya, that really raises the question for me, just how much wider that spread between market pricing and Fed projections can actually get in the coming months.
Sure, that's a great point. I think the market is used to a very preemptive Fed. Remember the Fed during COVID, remember 2008. I think we really have to go back to the 80s when the Fed was torn between its two mandates. And I think we're going to face that later this year because inflation is extremely sticky. Wages are still high. So it's hard to see how that core services ex shelter is going to come down significantly. As the unemployment rate rises, I think the Fed's going to be torn. And then we think they're going to be extremely reactive. Now, your point about market pricing, I think the market pricing in the very front end will have to respond to what the Fed does. If they continue to come out that they're not going to cut rates, I think that the front end, 1 year, 2 year rates will have to correct. I actually think that market pricing will increase in the long end because the more reactive the Fed is, the more they'll have to cut. And the market's not pricing in that many cuts. We're pricing in cuts, 200 basis points of cuts.
Right.
If the Fed starts to cut late, I suspect they're cutting a lot more because at that point, we're not just talking about a shallow recession, we're talking about a deep recession, and then the Fed will have to cut down to 1%, 2%, dare I say 0.
I would suggest that we're not paying attention to the real yield. It's collared here from a 1.65, 1.70 down to 1%. We've come in very tightly on the inflation-adjusted yield to 1.04%. Priya, what is the signal or the ramifications if the real yield, the 10-year real yield, falls under 1.00%?
I think that's telling you that the market really expects that things are going to slow down. I would say, 1% is a good level, but I think really a recession level would be more consistent with 0 or negative. So in fact, this tells me where real rates are, tells me that no market is pricing in a really hard landing, scenario. As if the market starts to get more convinced that we're heading into a hard landing, into a recession, that the unemployment rate is rising much more than the Fed forecasted it to, I think those real rates are going to go closer to 0. Because remember, how does the Fed stimulate the economy? Is by taking those real rates into very close to 0 negative territory, which is where we've been at in previous recessions. So I think there's a lot of room for those real rates to come down. But again, do you own front-end real rates or long-end? I would say right now, given that the economy is not very clearly heading into a recession right this second, it's better to own a little bit further out the curve.
Let's expand that. I don't want you to play economist here. I want you to play, your expertise in yield. But you say you don't see a recession coming. How do you dovetail that with what a team of PhDs at the IMF suggests or the economic data of the recent days?
So the economic data is weakening for sure. But, we were running at a very red-hot economic growth pace all of 2022, early this year. So things are going to slow down. I think it's the trajectory of the slowdown. It's just started to slow down. And what worries me is when we head into a recession, it's a very non-linear weakening in the economy. Very hard to forecast. Does that happen right now? Does that happen later this year? In our view, it happens later this year, that things slow down. And then when the savings buffer runs out and the banks start to tighten lending standards more, that's when it sort of heads into recession territory. Absolutely, the economy is slowing. But is it a recession today? We think not. And I think we don't know, and nor does the Fed. So we're all going to be looking at data. The market's going to run ahead with this narrative of a recession. And if the Fed says not so fast, I think that's when some markets, I would argue risk assets, are not pricing in a hard landing at all. I'm more nervous about where risk assets are rather than rates, because I think there's some weakening there that the Fed's not responding. If rates are low because the economy is slowing, that's not good news for risk assets.
Priya, well said. Great to get your thoughts as always. Priya Mishra there of TD Securities. Tom, what's more important to you? The Fed making a move or the why of it? The why?
The why of it to me is critical because the Fed's going to make a move based on data. They're going to be ex post, ex post, ex post. There's this entire gauze out there, this fog, if you will, that they're going to somehow be out front of this. It's grossly unfair to entry to any central bank as well. They're going to wait for the data, and as Priya says, when it goes fast.
Not all
and
rate
it's not
cuts,
about
Tom.
a Fed meeting.
Not all rate cuts are created equally. We've talked about this a million times. If you get that immaculate disinflation, fantastic. That's bullish, without a doubt. If they can reduce rates because of that, that's not what we're talking about here. We're talking about a disinflationary bust off the back of a banking shock. And what Priya alluded to there is really trying to get a better understanding of the long and variable lags of a banking shock. Never mind rate hikes.
A study of long and variable lags here is very much warranted, but this is a Fed that's going to wait for the data. And I'm sort of looking out to the late July meeting as being far more important. We got to get there.
Neil Dutto of Renaissance Macro writes in. He says this, I'd take the other side. There's more risk in
Why
bonds.
did I know that?
There's more risk in bonds.
Oh, I thought he was talking about Tiger Woods.
No.
Oh,
no.
geez.
You're focused on the Masters, aren't you? I find Augusta National so relaxing.
Yes, exactly.
It's like therapy. Said that a few times.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Make a coffee, stay in bed. It's going to be a bit of a snooze until about 8:30 Eastern time.
Bitcoin's
After that,
trading.
get some fireworks. Equity futures right now on the S&P 500. Negative not even 0.1%. Equity futures still trading. Of course, cash equities closed today for Good Friday. Cash bonds, treasuries opening up in about 30 minutes time, Tom. Going into that open, 382 is where the 2-year closed just yesterday.
Yields down. The 10-year was testing earlier today a shockingly low level. I mean, we're back to Steve Major territory. Let's just say that
Back in the threes.
We've had a shift here.
You mentioned Steve Major. Bob Michael at JP Morgan Asset Management thinks the whole curve, 2s out to 30s, 3.0%.
That's stunning.
In the next few months.
And that goes to what we were talking to Priya Misra about, is how this 10-year real yield, which I don't think gets talked about enough, is coming down, showing that not malaise, but just that economic reset we're talking about.
Just to return back to the calendar, we talked about this a lot. At about 8:30, so 60 minutes from now, we'll get the payrolls report in America. On to April 12th, the CPI report. Then for those of you interested in the bank earnings, and I know many of you are, First Republic, a name we've talked a lot about, Tom, in the last couple of weeks, they report, or at least scheduled to report, on the 13th. On the 14th, you'll hear from JP Morgan. So lots of bank earnings coming next week too. The estimate today, 230,000. Alan Zettner of Morgan Stanley calling for something around 240K and saying the following: we expect net new job creation to decelerate, Tom, from the February pace as labour market indicators have started to show signs of easing and the effects of seasonal factors normalize.
It's an important conversation right now as Ellen Zettner on the high ground on analysis of the American consumer, folding that into our economic growth over the years, the tours of duty she's had. She now holds court at Morgan Stanley as our chief U.S. economist. Let me go back to a question I'd asked you 10 years ago. How's the American consumer fit into the supposed economic slowdown we're living right now?
Well, I think a lot of it has to be driven by the consumer. 70% of the economy, it's going to dictate GDP. So we front-loaded a lot of economic activity into January and February because of the warm weather. We've had a large stimulus program end in March. You take a hit on government transfers to households. You do have slowing job gains. So you've got negative disposable income going into the second quarter, and consumer spending and GDP are going to be negative in the second quarter. So I think even though we're not calling for a recession this year, coming in with negative GDP, right, it's going to keep those recession fears alive.
Do you model a negative non-farm payrolls statistic as David Kelly talks about at JP Morgan?
So we have payrolls slowing down pretty sharply in the months ahead. By the middle of the year, we're down to 40,000. Now, 200,000 is one standard deviation. If you cut out the COVID period, that standard deviation blew it out to about 1 million.
Sure.
But before COVID, standard deviation was about 200,000. So at 40,000, it could be well negative, or it could still be quite strong. But we've been expecting this really marked step down in job gains that just never seemed to come. Every month we were getting a big report. We'd push out our expectation by a month of that slowdown. And we were very close to coming back to the table and saying, when do we admit we're just wrong? We're just not going to get the slowdown. This is the first time that this payroll report, because I do think there are downside risks here. I think the market is looking for a one handle on this number. And it's the first time that it feels like this could be the start of that more notable slowdown in job gains. And that's what we really need, right? We've got to take pressure off the labor market, off wages. We've got to have more slack in the economy.
That language at the end there, that's what we really need.
Yeah.
That's what we've been talking about for a year. JOLTS, job openings. For a long time, everyone said that's the target, that's the objective, get it lower. Then it happened this week, and all of a sudden that's bad. Has the story changed?
Well, I think be careful what you wish for. Look, the drop in job openings, JOLTS, we saw it in August, and we thought this is the beginning, and then it flattened out and kind of increased again. Now we've got a big drop again. You know, the chief economists that I hobnob with, right, in that environment, at Indeed, at LinkedIn, they've been putting out these reports for some time showing that job openings have been dropping. Indeed, even calling them phantom openings. And it just hadn't been showing up in the official data. Now that it shows up in the official data, the question is always, oh my gosh, wait, now we're going to have a big slowdown in jobs. Does that mean negative? And so, because right now you could imagine a market on pins and needles, investors that are nerves are still stretched thin after the bank funding pressures emerged. And so you're looking for the negative side of things. Have we gone too far? Are we just going to run off the cliff here with jobs? And maybe in a month or two, we're already to negative job gains.
So we've had a year of upside surprises on payrolls. Tom and I were talking about the data. I was going back through it this morning, Ellen. I think it was literally the March report in April was the last time we had a downside surprise on a payrolls report.
Yeah.
The reason people believe we could have a downside surprise this week is because we've had a series of downside surprises so far this week. What can you read into what we saw in the ISM manufacturing and the ISM services read we got earlier on?
Yeah, so the ISM is a diffusion index, so it's not quant prior month, for instance. And so that is in line, but the ISM diffusion index doesn't necessarily tell you exactly what the quantity of jobs is. It just tells you that you're probably right that we created less, say, service sector jobs than the prior month. But you had upward revisions in initial jobless claims. So before the upward revisions yesterday, we had jobless claims that were about flat with the survey week in the prior month. Now they're up about 30K compared with the same time in the prior month. So again, like you said, it's been a string of downside surprises, which has set the tone for the report today.
How do you write your weekend note into Monday off of what the IMF said yesterday? I was thunderstruck at a 5-year, 3%-ish or even lower global growth. To me, in my textbooks, that's a global recession. Does Morgan Stanley model something so grim?
So, there are quite a few. So grim, yes. We're above 2.5%, which is sort of the threshold, at least that, say, OECD puts out that says that's a global
GDP
recession.
Above 2.5%.
Yeah, so we have global GDP above 2.5%. Not much better than the IMF.
This is a new era.
But look at, in the U.S., Tom, we're forecasting 0.3% GDP on a Q4 over Q4 basis. We have a negative quarter in the second quarter.
So what does that do to non-farm payrolls? Give me a 3-month, 6-month non-farm payrolls moving average off of your 0.x statistic GDP.
Well, so if you're looking at a 3-month moving average by the middle of the year, so we get out of these very early in the year, very big reads, then you're talking about less than break even on payrolls, 90,000. So you should start seeing the unemployment rate moving more quickly then.
Let me make this clear, folks. From yesterday morning in the speech of the managing director, this is a massive global and domestic reset. This is not a normal Good Friday jobs report.
Oh, not at all. To Ellen's point, there's a real belief that maybe this is the month, after saying that for about a year, perhaps this is the month where we see that weakness. When we get to May 3rd, or rather when the Federal Reserve gets to May 3rd, do you think they're going to have sufficient information about the banking shock to make a decision one way or the other? And if they're unsure, is the bias to hike or is the bias to wait?
I think if they're unsure and they're uncertain, then I think financial stability will win out. I don't think that this close to wherever neutral may be, that you're going to quibble over 25 basis points. And I think you can double down on your message that we've got rates into sufficiently restrictive territory, and so we are going to hold them there for some time because we're still vigilant in our battle against inflation. That's still the market disconnect, is the market expecting several cuts before the end of the year, and the Fed's still saying we're not going to cut till 2024. It's just, it's going to be that tug of war. Maybe we have one more battle between that of the don't fight the Fed, and then the data is either going to prove that the Fed's going to need to reduce rates before the end of the year or not. But I think we're still a little ways off from them determining that.
Long and variable lags. We've asked this question a few times over the last week. What are the lags of a banking shock in the nature of the banking shock that we've had over the last month?
Yeah, so look, you can see in the weekly data that we are back at a period of relative stability, but you can also see that obviously liquidity was needed and is still needed for parts of the banking sector. But you've stabilized that, but you're still going to have slower loan growth. So to give some context, loan growth was about 10% in the first quarter, really strong loan growth. If it slows to around 2% by the end of the year, which I think is a good assumption, then it took down our growth forecast another 1/10 this year. So we were at 0.4, now we're at 0.3 for this year. Now, you may think, wow, that's not that big of a change. The bigger change is in 2024. Because I think what surprises people is how long these credit shocks take to move through the economy. This is not a credit crunch. I know it's a really nice term to use. We've not cut off the flow of credit to the economy yet. That's a credit crunch.
Apollo said it is.
But a credit shock, that impulse moves through the economy. You can start to really see it in the third quarter. The largest cumulative impacts come in the fourth quarter this year and first quarter of next year. So it takes 2024 growth down more so than this year. But you're just putting a lot of weight on a year when we're barely above water.
Iconic, when I used to go to China umpteen times a year, was you'd get off the plane in Hong Kong and you go down the corridor, and there was a Steve Roach Morgan Stanley billboard of Morgan Stanley greeting you to Asia, Morgan Stanley greeting you to Hong Kong. Can you run that billboard now? Can you tell Mr. Gorman he can run that billboard effectively? Or is the U.S. so disparate from China, Morgan Stanley can't make that gap for business?
No, I think that, look, we're going through global shifts. And we've had this conversation, this narrative with China, looking at how we can massage our trade with China, how we can make it more fair. I think it became, more difficult when it played out on the public stage in the last 6-8 years. But these conversations and these shifts are ongoing. Our strategists have put out great research calling this the multipolar world. And it means that you can still do very strong business in China, but from a manufacturing standpoint, those trade ties do need to shift.
Ellen, this was wonderful. Thanks for being with us in person. Ellen Zender there of Morgan Stanley. Tom, what a year so far. It's only April.
Yeah,
we had
it's
soft landing,
exhausting.
no landing, hard landing, tons of cuts in between.
And what's so
It's
important
nuts.
here in the reset is this market, I mean equities, particularly equities, but equities, bonds, currencies, commodities, are we modeling in a sub 100,000 run rate on non-farm payrolls? I would respectfully suggest we aren't.
I'd suggest this bond market is anticipating some real weakness. And to Priya Misra's point over at TD, no real signs of that at the index level on the S&P 500, Tom. Still stuck in that range, 38 to 4,200.
Oh, it's stunning. Yeah, there's been some really nice charts of this off the Bloomberg comparing equities SPX versus whatever bond flavor you want, and it's two different worlds right now.
For once, some muted price action. Equity futures really not doing much going into the print at 8:30 Eastern Time. About 50 minutes from now, we'll have the payrolls report at 8:15. So in about 30 minutes, we'll catch up with Randy Crozan, the former Fed governor. Looking forward to that conversation. Before that, Mohamed Al-Arian joining us for the hour in about 20 minutes. Looking forward to that as well. Equity futures essentially unchanged. Your payrolls report just around the corner. The estimate, 230,000.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Russia may quit the Ukraine grain deal if obstacles in the way of Russian grain and fertilizer exports aren't resolved within 60 days. And that's according to Russian Foreign Minister Sergei Lavrov, who spoke in Turkey today. Despite Lavrov's comment, Russia is forecast to be the world's largest wheat exporter in the 2022-23 season, and its export prices have become the de facto global benchmark. Taiwan officials say they still expect a visit from U.S. House Speaker Kevin McCarthy. McCarthy met Taiwan President Tsai Ing-wen earlier this week in Los Angeles, stressing the importance of the relationship between the two sides, economic freedom, peace, and stability in the region. The location was apparently chosen to avoid a repeat of tension seen in August when Nancy Pelosi became the first sitting House Speaker in 25 years to visit Taiwan. It may not feel like it, but when you're grocery shopping, but global food costs are falling. A United Nations index of food costs slid for a 12th straight month to its lowest level since July 2021. Still, the gauge is up almost 40% from 2 years ago, and officials say there's little indication that the decline is actually feeding through to store shelves. And Samsung is cutting its memory chip production after reporting its slimmest profits since the 2009 financial crisis. Operating profit missed estimates, falling more than 95% to $450 million for the 3 months ended March. Sales dropped 19%. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative.
It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I'm afraid about the market because if you have a credit slowdown and you have an economic slowdown that follows from it, you're going to have an earnings slowdown. You're going to have a revenue slowdown, effectively an operating slowdown in the corporate world.
That was Terry Wiseman, the global interest rates and currency strategist over at Macquarie, weighing in on this slowdown. Is it really a credit crunch? Torsten's Apollo Slock says it is, and Zetra Morgan Stanley says that's not what we've got in front of us right now, and that's the debate at the moment going into payrolls. The number for payrolls drops in about 44 minutes. 8:30 Eastern time. Counting down to that data at 8:30, Anna Wong of Bloomberg Economics expecting a number of 230,000 to be the number we see a little bit later this morning. She says this: the payrolls print, as well as jobless claims and jobs data released earlier in the week, likely will convince policymakers that rates are close to a sufficiently restrictive level. Bloomberg Economics Tom expects the Fed will hike by another 25 basis points to 525 at the May meeting, then hold rates there for the rest of the year.
There's a key phrase for the rest of the year. Yep.
Hold, not cut.
This is so important. Anna Wong, with really courageous leadership, it seems years ago, in saying reset to a higher belief in the interest rates. And Anna Wong joins us now, Chief U.S. Economist for Bloomberg Economics. That's sort of where I am, Anna, is lift, then pause, pause, pause. What is the effect on our viewers and listeners of pause, 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 or even 4 pauses into the end of the year?
Well, I think that so we looked at the transmission of monetary policy to financial conditions, and the lag is now significantly shorter than what traditional models would tell you. I think once the Fed paused, immediately the financial markets would be rallying, and our model sees financial conditions loosening to a degree where the cumulative effect of monetary policy would shift back to basically neutral by the time of mid-year this year.
And I've got to go to your academic work at Chicago. I was thunderstruck yesterday at a 3% global growth statistic from the managing director of the IMF. You had the honor of studying with Raghuram Rajan at Chicago. What does a 3% global growth statistic mean for America?
Well, you know, so the transmission from global economies to the U.S. economy actually primarily operates not through the trade channel. U.S. has a very small export manufacturing base, so it's not like we are going to benefit from this. And also in terms of oil's impact, so when global growth is strong or weak, if it's strong, then U.S. export would have a terms of trade, positive terms of trade shock. But I don't think that's what we're seeing. I think the shock facing the global economy primarily stems from what the Federal Reserve will do. And if the Fed does pause mid-year, then I think it will be overall that effect, the stimulative effect, will be even stronger than whatever spillover is coming from abroad.
John, this is the dynamics, and I don't know how to get to the gloom of the managing director over to this jobs report, because I'm hearing from Dr. Wong there that the global GDP ballet is actually separate from the American labor economy. We're going to learn about that in the coming months.
Well, the nature of the financial shock in the United States is so different to what others have experienced. Yeah. In Europe, it's certainly not the same. We can point to Credit Suisse. Then that's the major difference right here in the US right now. And when you talked about financial conditions, I believe you mentioned equities and risk assets would rally. I just wonder, should we care about that? What matters more, financial conditions that track things like stocks or tracking lending standards in the Senior Loan Officer Opinion Survey that we'll get in the next month or so?
Yes. So in the Chicago Financial Conditions Index, which is, I think, our preferred index, they separate into risk assets versus credit channels. And the lending survey result actually shows that credit has been tightening long before the collapse of SVB, and that channel of monetary policy transmission takes somewhat longer than risk assets. So risk assets will rally immediately when the Fed pauses, but the credit channel will continue to see some tightening even after the Fed pauses. So I think in terms of the effects of Fed policies on the real economy, the credit channel, indeed it has a tighter linkage.
Anna, what you just said is so important. That trend predates the banking stress of the last month or so. So, Anna, with that in mind, when would you expect the banking stress to go through the credit channel and arrive in the economic data on our screens? Payrolls, CPI, all of the above. How long does that take?
So I think that our model shows that the transmission effect of credit channel takes about just maybe 3 to 6 months. And in terms of the whether the credit channel is tightening, the variables we look at is spreads of corporate borrowing rates from Treasury yields and also VIX, and all that seems to us suggest to us that this banking shock is just transitory. So we estimate that it only substitute for about 25 to 50 basis point of rate hikes for this year. So I think the slowdown this year primarily is due to the cumulative effect of Fed tightening rather than the marginal effect of the banking crisis.
Anna, I just want to pick up on something you said. You think the banking shock will be transitory. Can you tell me precisely what you mean by that? Are you suggesting that any tightening in lending standards, that's what's transitory, or the hit to data is transitory? What do you mean exactly?
Yeah, what I mean is, imagine a week or two ago when the credit spreads were widening by, like, I think at one point over 80 basis points. And that hit is very substantial. That would be very substantial to the real economy were that spreads to continue to widen at that level. I mean, back in the GFC, credit spreads widened over 150 bips and stay widened for over a quarter. And that is the effect of like a very strong adverse shock to the economy. But we already see the spreads widening, coming back down closer to the levels before the collapse of SVB. That's what I meant by transitory, to have a real durable impact on the economy in terms of how it translates to, economic models. You really have to have that CDS spreads widening by and stay high for a long time.
And a model for me just something like Anna Wong 101. At what unemployment rate does Chairman Powell and the Fed, do they change their dialogue? We're going to get an unemployment rate today. John knows what the survey is. I don't never look at the data, but is it like a 4% OMG, the world changes? Do you have in your head an unemployment rate that is critical for the chairman of the Fed?
Yeah, so the Fed forecast that unemployment rate would reach 4.5% by the end of this year. So anything higher than that, so if suppose that the economy reached 4.5% mid-year rather than end of the year, that would change the Fed's calculus, right? And if that's the case, then I would see the possibility of cuts in the second half of this year. But I think right now the unemployment rate is on track to be undershooting 4.5% rather than overshooting. So maybe everything will change in an hour, but as of now, I think the tendency is for people to have to downwardly revise the unemployment rate for the end year.
Wow, interesting. Anna, this was a clinic. Truly, thank you.
She showed up. Anna, you showed up completely not media savvy, and now she's getting the whole idea of teasing.
Everything might change in the next hour.
To the next hour.
Isn't it true, though?
Analog Market Pro.
The whole narrative changes at about 8:30 Eastern Time. It often does.
It does, and we're at a point where we're going, like you mentioned, the length of the year so far. And we're really going, folks, day to day with banking crisis and all that, where every day there's a surprise where I go, wait, have I seen this before? And what's going to be today's surprise? I don't know.
I will say this, though, Tom. I'm not sure it matters how strong that data point would be at 8:30. I don't think it would change the story for a lot of people. If it's super strong today, I think people would be willing to ignore it. If it's super weak, I think it would confirm the priors. And the bias right now is to believe that we're going to have a serious hit to growth off the back of the banking shock.
Yes.
And the 12 months of tightening we've had from the Federal Reserve. I just wonder how much strong data you need for how long to change that story.
The Ellen Zentner picture here of 40,000, under 100,000, 70,000, 40,000. I don't think anybody has that into their market call, including in the equity market. What's the biggest struggle here on a Good Friday jobs report? We're having Sanka. When you grew up in England, did you know what Sanka was?
Are you suggesting in an Italian household?
Exactly.
We would,
I can't imagine.
Sanka.
I mean, Marmite's bad enough, but Marmite's like gourmet compared to Senka.
You could smell the freshly roasted coffee beans in my kitchen as a child, Tom.
I can't imagine. I'm wicked jealous. I mean, it's great.
Real deal.
It's like you and me at Lake Como at that fancy hotel.
We missed that. Do you know who made it down there? Mohammed did.
Was he there?
He was there.
He's everywhere.
He's going to be with us shortly. Mohammed Al-Arian of Bloomberg Opinion and Queen's College, Cambridge, here in New York City. Up next, counting it down to the payrolls report, 34 minutes away. The estimate in the Bloomberg survey, 230,000. The data just around the corner.
So most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. He has mercy. The other one has no mercy.
The moment news breaks, no one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Wall Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the Fed.
They're moving data point by data point.
Is this basically just whack-a-mole?
Inflation in Focus, Wednesday on Bloomberg.
Inflation is continuing to melt, which will allow the Fed to eventually ease.
Inflation might not be as big of a problem if we get into a recession. I think the recession will do the job.
If something bigger breaks and a crisis supersedes inflation for the short term, that could lead them to cut.
The trouble will come in the second half when we then are actually facing much higher growth expectations.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The payrolls report 30 minutes away, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and on radio alongside Tom Keene. I'm Jonathan Ferro, joined together by Mohammed Al-Arian in the studio here in New York City. Going into this jobs report, futures take a little bit of a leg lower. I wouldn't read too much into this. We're down about 0.2% on the S&P. The estimate, if you're not familiar with it just yet, 230,000 is the median estimate in the Bloomberg survey. TK, we've had upside surprise after upside surprise for the best part of 12 months with the jobs report. Does that change today?
Is this the day that it tips? And I'd also link it in, John, with the study of the domestic economy here, with the international economy, as we had Kristalina Georgieva yesterday to have Dr. Al-Arian today, the kickoff to what we're going to see next week, and how America in this jobs report folds into a pretty grim IMF global growth.
The rules of combat for the next 60 minutes, this conversation, Tom, you cannot mention QPR. Okay, we on the same page? You can't talk about Queen's Park Rangers. Okay.
Well, Mohammed travels with an entourage of, like, I think it's 7 people, and maybe he's pared it down because he's now with a university. He's down to 5 people, and one of them whispered in my ear, just whatever you do, don't say Preston, don't say Preston, don't say QPR.
Go into the door.
Yeah.
Mohammed, we won't talk about your beloved football club, okay? We promise.
I just wonder what happened to the other 6 people I travel with. I haven't seen them in my whole life.
Well, they're there. You know, it's like my interns over here. I have a key question. How would the Fed be different with a pitch clock? I mean, in baseball, you know, the pitch clock's working from what I see. But do we need at the press conference a clock going?
No, I mean, I think they control the clock really well. That's not what they need. They need other things, but not a pitch clock.
Well, let's talk about what they'll get in about 28 minutes. 230,000 is the estimate. Mohammed, we've had a series of misses so far this week. Can you read something into that for this?
Well, certainly the market has. Not only has it revised the consensus forecast, but the rumor number is below the 230. And that is consistent with everything else we've seen. I find it fascinating because we have question marks not only about the jobs report, but it comes at a time when it's a 50-50 situation as to what does the Fed do next. So this report is going to be much more consequential in a way than others have been.
This is a risk management job for the Fed. You've questioned their ability to do that appropriately. The decision they've got to make on May 3rd is a difficult one, as you've pointed out. Do you think the bias is to hike or is the bias to pause? Because the bias of this market is very, very different. Quite clearly, this market will discount anything that shows resilience in the economy and embrace anything that shows weakness. On May 3rd, when this Fed sits around that table, given the limited information they have, is the bias to hike or hold?
So let's assume we don't know what the number says on May 3rd. I think the bias right now is to hike. You've heard that consistently. There's 2 reasons for that. One is credibility, and 2 is they are really worried about repeating the 70s mistake. They are dealing with a trilemma. Financial instability is an issue they have to worry about. But the good news, John, and I think this is important, is the financial contagion risk is much lower today. Unfortunately, we're dealing with the economic contagion risk.
Jim Bullard yesterday said you can deal with the 2 separately. I found it somewhat confusing because at the same time they're telling us that one is a substitute for the other. Can you make sense of that?
I can. I mean, he's rightly referring to the separation principle, which is you use monetary policy, interest rate policy for inflation. You use other tools, which they have a lot of, as we've seen, for financial stability. Now, there are clearly interactions, but I think it is correct to start with the presumption of separation of policy tools. Otherwise, if you use one policy tool for multiple objectives, you'll end up in the muddled middle.
The overlay here is critical, and you have tangible experience on this as Deputy Director IMF back in the early 1990s. Kristalina Georgieva dropped a bombshell yesterday of a 5-year, 3% growth model for the IMF. How does that affect America? To have that grimness, which we haven't seen since the early 90s, to have that grimness, how does that affect the people watching and listening?
So let's add 2 more data points. Last week, the World Bank came out with a study that showed that potential growth was coming down. So it's not just actual growth, it's potential growth. Our ability to grow is coming down. That is also bad news. Let's also add the other bit of data, which is that certainly for this year, as the managing director said, China and India account for half the global growth.
Right.
So there's massive dispersion within a number that itself is too low. How does that affect the U.S.? In multiple ways. The U.S. needs the global economy to grow, not as much as other countries, but still needs it. It means more likelihood of debt crises. The U.S. has an interest, an economic and a geopolitical interest in debt crises, and it makes policy coordination, where the U.S. plays a key role, much more important.
Your father was ambassador of Egypt to France. Mr. Macron is in France right now. Again, let's bring this back to this morning's jobs report. This gap between the United States and China is tangible. How does that affect the spirit of the American economy as seen by this jobs report?
So first of all, that gap is not only tangible, it's long-lasting. It is not going to go away. It reflects national security considerations. It reflects uneven adherence to international standards. So this thing is not going to go away. What it means is fragmented globalization. The U.S. has to think differently. Multinationals have to think differently about how they deal with globalization. But Tom, we're in a better place than many other countries, in a much better place.
Right.
To navigate
this is right where I wanted to go. We're going to do a panel. I'm going to be with Dr. Larian in a panel at the IMF a week from today, actually, with Olivier Blanchard and Gita Gopinath. This is critical. We have the advantage of a technology overlay. How does that change the action of the chairman of the Federal Reserve to know he has the trump card, no pun intended, he has the trump card of American technological excellence?
It won't change anything in the short term, but it does change in the long term. We don't just have that trump card. We also have an incredibly diverse economy. We are much more energy independent than most other countries, and we have incredible entrepreneurships. We have to navigate three major transformations over the medium term. Doesn't impact the Fed today, but will impact the Fed later on. One is the green energy transition, absolutely critical. Two is the digital transition, absolutely critical. And then three is the supply chain transition, absolutely critical.
What's critical to me, John, is all that matters is if you see 110,000 print on Friday's jobs report, all the stuff at 60,000 feet with Dr. Larian drifts away.
Can we pick up on point 3, the supply chain shift? Adam Posen at the Peterson Institute earlier this week said that maybe it was a bit of a fallacy to believe that bringing supply chains home increases resilience of the supply chain. Now, I think we know that based on what's happened with some command economies over economic history. Do you think that is also a bit of a fallacy?
Look, it depends what you think the supply chain is most sensitive to. If it's most sensitive to geopolitical shock, then bringing it closer, friend-shoring, near-shoring, certainly increases your resilience. If you think of it as being subject to other risks, then Adam has a point. But I think the focus right now, John, is on national security, on geopolitical issues. That is what's driving the government-led fragmentation of globalization. There's also the private sector-led fragmentation of globalization when companies want to have more sources of supply.
So you'll remember it was only 5 minutes ago we were talking about the secular component of the inflation story. And then that all went away after the banking crisis. But that's still something we need to focus on, isn't it? Don't we face higher inflation rates because of everything you describe?
Oh, absolutely. Thank you for bringing it up. One of my biggest frustration has been excessive data dependence. Not data dependence, excessive data dependence. You've got to be anchored by some strategic view of the economy. And this Fed, unfortunately, hasn't embraced the strategic view. The only one it has comes from the new monetary framework, which is built for the world of yesterday. The world of deficient aggregate demand. Today, and for the next few years, we're in a world of deficient aggregate supply. That has an inflation bias to it and makes the Fed's job even more difficult.
Do you think the Fed is aware of that? Have they acknowledged that sufficiently?
I think they've been excessively data dependent. I think they are standing behind data dependency because they don't want to be held accountable for yet another mistake.
How can we hold them accountable? I've got to jump in. Luigi Zingales, a man you know well from the Chicago school, said this to us yesterday. He said, in the last 2 years, the Fed has failed twice. It has failed to see inflation coming. It's failed to see the banking crisis coming. He really believes there's an institutional problem at the Federal Reserve. Do you believe it's a leadership issue, or is there something wrong with that institution?
They have two significant structural deficiencies. And I've talked about this because it's been failures of analysis, policymaking, communications, and forecasts. That is significant. So failure number one is accountability. You either have endogenous accountability, and as the professor said, they still haven't owned their mistakes. The ECB has owned its mistake, the Bank of England has, the Fed has not. So either you have endogenous accountability, which is important because you learn from your mistakes, or you have exogenous accountability. They don't have that either. So the first issue that they need is accountability, which they don't have. And it's some level between Congress, which focuses on general things, and the internal side, which doesn't own the mistake. You can fix that. The other one they have is lack of cognitive diversity. Unlike the Bank of England, they don't have external members. Unlike the ECB, they don't have a wide range of national governors who are constructed in a very different way. So they end up in groupthink. So they get stuck on some narrative, transitory inflation, which they don't change.
This, after the jobs report first, we've got to really pay attention to this report, John, but I'm sorry, this is the theme with Dr. O'Leary.
This is precisely what Luigi was talking about yesterday, the groupthink at the Federal Reserve.
And I say it with respect to the institutions. You know, there's a whole history of this, but I think the groupthink is profound, and I love what the Bank of England does. They have Catherine Mann over there.
Oh, to Mohammed's point, they have external members on the MPC.
Yeah. Adam Posen was there at one.
That Mohammed do this original thing. They dissent. Why won't people at the Fed dissent?
We got through that without mentioning QPR. I thought
we
that
did.
was pretty good.
That means we get bonus out with Mohammed. He's going to be sticking with us, I'm pleased to say. The payrolls report about 18 minutes away, the estimate 230K, and then a little bit later, we'll catch up with the administration. Looking forward to the conversation with the Commerce Secretary a little bit later in the next hour.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Secretary of State Antony Blinken says China wants to have it both ways when it comes to the war in Ukraine. In an interview with the European news network Euronews, Blinken said China is trying to advance a ceasefire proposal while also backing Russian President Vladimir Putin. He added China should be focused on urging Russia to respect Ukraine's sovereignty and to give back to the territory it has seized by force. Israel strikes back after the most sustained barrage of rockets launched from Lebanon and Gaza in 17 years. Israeli jets bombed Hamas sites in the Gaza Strip early Friday, causing property damage but no injuries, according to Hamas officials. Israel targeted underground tunnels and sites used for weapons production. In Tennessee, Republican lawmakers have expelled 2 Democratic colleagues in retaliation for their participation in a gun reform protest from the House floor last week. Justin Jones of Nashville and Justin Pearson of Memphis were stripped of their seats in the first partisan expulsion in the body's history. The Democratic lawmakers had addressed hundreds of people demonstrating in the wake of a shooting at a Nashville Christian school. Replacements will be chosen in a special election later this year. And Tesla is slashing the prices of all of its vehicles in the U.S. It's an effort to shore up weakening demand for its electric vehicles, as CEO Elon Musk vows to chase volume over profit margins. Price tags have been trimmed by $1,000 to $5,000. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
London and Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Wall Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg Surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the
They're
Fed.
moving data point by data point.
Is this basically just whack-a-mole?
Inflation in Focus. Wednesday on Bloomberg.
If you look at Silicon Valley Bank, I don't think that they have a return on assets that justify a higher deposit. That's the conundrum. If the problem was solved simply by increasing rates, it would be easy, but they cannot afford to.
So you're saying this banking system does not work with rates of 4% plus? Is that basically what you're saying?
Yes.
What a fantastic conversation with Luigi Zingales, the Professor of Finance at the University of Chicago Booth School of Business yesterday. You can find that in full on Bloomberg.com and on the Bloomberg Terminal. We are counting you down to the payrolls report. Welcome to the program. If you are just joining, that payrolls report drops in about 13 minutes' time. The estimate, 230,000. It's come in a bit through the week off the back of a series of downside surprises, economic data misses through the week, whether it was the ISM business, manufacturing services survey, whether it was the ADP report, JOLTS, the wrong kind of upside surprise on jobless claims as well. Spooking a few people out there. It's meant a rally in the bond market. The two-year yield started the week close to 4.1%. It's ending the week close to about 380, dependent, Tom, on what we get in about 12 minutes.
I'm watching the 10-year real yield as well, the inflation-adjusted yield has come in, and I'm waiting for a 0.99 statistic, which to me is a big deal, but Priya Misra earlier saying the distance to gloom there is near a 0% 10-year real yield. We're not there yet.
Equity futures, TK, down about 0.2 of 1%.
We are so privileged on this special jobs report and all of our coverage, including our team showing up on radio and on television, to just have sterling guests with us. Joining us on set is Mohammed El-Arian of the University of Cambridge, among other abilities, and joining us with great ability from the University of Chicago Booth School, as always, is a former Federal Reserve Governor, Randall Krosner. Randy, I want to go off financial economics with you. You own the high ground here. What is the measurement of uncertainty that we have, not so much on this jobs report, but where we are right now in studying the American economy?
That's a very important point, because one of the issues that people have been debating is the inflation dynamics and job market dynamics. That, is there something that's different than the way that people had traditionally thought about it? And the Fed's been at this a while, and interest rates have gone up a lot. And of course, another University of Chicago economist, a very great one, Milton Friedman, had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog. More than a year that the Fed has been tightening, and we really haven't seen the labor market crack. That's kind of what people are looking for today. Are we seeing signs of the labor market cracking?
Right.
And when it comes, maybe it'll come a lot more rapidly than in the past.
A lot more rapidly. My history, and this is not the sophistication of Frank Knight or George Stigler onto Friedman and onto Krosner, but just the blunt instrument is that when it slows down, recessions happen rapidly. Is that your take, that when they go, they really go?
Yeah, I think our models often say things move very smoothly and gradually, but I think it's often the case in the labor market that it can move pretty rapidly. And that's one of the things that the Fed worries about, and that, of course, economists and business people worry about, that could this what seems to be an extremely robust job market move rapidly into one that is not so robust.
So, Randy, given the long and variable lags point you just made, are we excessively data dependent? Do we get whipsawed all the time? When I look at what has happened to the 2 years, in the last 30 days. It's a 150 basis point swing, makes even cash management really hard, causes all sorts of issues. At what point can we step back from every data point and take a longer term view, and rather than get whipsawed like this, like we have been?
Yeah, I think that would be super great, but I think part of the reason for that is this uncertainty about the underlying model. I think when people sort of, not only the Fed, but the markets have kind of the same broad model of how the labor market works and inflation dynamics, then you don't get these sorts of whipsaws. Now, because of so much uncertainty about what the underlying model is, you get some strong reports. The interest rates go up. You get some slightly weaker reports. The interest rates go down quite a bit. And then of course you've got the tumult of the banking tumult in the background, and I think that's made things even more fragile.
There's been a lot of criticism about forward policy guidance. There was a recent study that showed that volatility during the press conference is 3 times as high as it's been in the past, and the message tends to be inconsistent with the message of the statement that was issued just before the press conference. Are you surprised by the outcome of that result?
Yeah, I think that's well, I don't know about the particulars of the volatility during the press conference, but actually, Jonathan and I had talked about this a month ago. So I think that the Fed's message is quite consistent and quite clear. Ever since the markets didn't believe Jay Powell at the beginning of July a year ago, that they really made inflation the #1 priority, and they're going to keep at it until inflation comes down. You know, he ripped up the traditional Jackson Hole speech, made it much shorter, just 8 minutes, and he said the same thing 8 times, which is what I just said. And I think they've kept at it. Now, of course, you know, the data have come in different ways, and so they can't tell you exactly, is it 25 basis points, 50 basis points, 75 basis points? But I think the overall message has been fairly consistent.
Randy, you know I'm going to take the other side of this, but
Sure,
we've
and
known
that's
each other a long
great.
time, so I'm going to jump in. Mohammed, that is the establishment view of the Federal Reserve and Chairman Powell. And there are many people watching this program who just listen to that and just think, what's Randy talking about? Consistent. I heard the speech. We were in Jackson Hole, Wyoming, 8 minutes long. Got it. Great. And then there was a conversation in December where he seemed to back away from it. Then he started talking about disinflation. The disinflationary process has started at the time where the economic data was super robust. Do you think the Fed's been as consistent as Randy Krosner is suggesting?
So I would love to agree with Randy, my friend, but the answer is no. It has been inconsistent. Disinflation was mentioned over 10 times on February 1st. Once you mention that word over 10 times, you send a signal, and the markets moved in a major way. So, Randy, I would love to agree with you, because I think this volatility is actually breaking things, and it's unnecessary. But it's not because the message has been consistent, it's because the message has been inconsistent.
I mean, inflation started to come down, so he's starting to talk about disinflation. I mean, that's what the data are saying. So I don't see any inconsistency with saying that.
Mohammed, do you want to jump in?
No, I think I'll leave you.
Randy, we're going to continue this conversation around the table. I know you're going to join us after the payrolls report, so thanks for being with us. We're going to do that in about 6 minutes' time.
If he stays around.
I think Randy's going to stick around. We did this last time.
No, this is the debate.
Look, this is the debate. Randy's put out his point. Mohammed, essentially it's that the Fed changed because the data changed. You don't share that view.
I think you cannot be overly data dependent. It's like, I mean, I can give you many examples where that causes accidents. You've got to have a view of where you're going. You've got to have a view of your destination.
This is critical. We talked about Chicago economics and, you know, the privilege of talking to the laureate Michael Spence, studying under John Hicks. Let's go from John Hicks to the laureate Michael Spence to Mohammed El-Arian. Is any of that theory along the way apt now? I mean, Begg, the textbook Begg, I don't know if they use it at Cambridge. Is any of this in the textbook in the United Kingdom, Begg?
So the most important insight here comes from Mike Spence, which is the importance of signaling and what happens when you get asymmetrical signaling and how markets break down. I mean, don't underestimate the role that the Fed plays. We all embrace the Fed. We all embrace its political independence because it anchors the system. If it no longer anchors the system, then you get financial accidents, you get economic accidents, and the rest of the world, to quote a FT article by Edward Luce, starts hating the Fed because they see it as a source of instability.
But we've got to go here and get to this important jobs report. For Dr. Alarian, very simply here, if it is an asymmetrical theory right now, where does a pause fit in? Which way does a pause tilt?
That is really difficult. If they didn't have a credibility problem, the pause fits in really well. But they're also dealing with a credibility problem. So that is why they haven't changed their narrative.
Got a great message that I think Mohammed's going to agree with, and maybe not Randy. The Fed has been consistent lately, consistently wrong. It's the message I just got on the Bloomberg.
I'm not that harsh. I'm with Dr. Krasner.
The payrolls report, 4 minutes away.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
The payrolls report, seconds away, the number, the estimate, 230K. Mike McKee's going to break this down for you. Going into it, equity futures negative, a little more than 1/10 of 1% on the S&P. I'm not going to share the whisper number with you right now, because people might confuse that with the actual number, which hasn't come out yet. In the bond market going into it, 383 on a 2-year yield. That yield much lower on the week, off the back of weaker economic data. With the jobs report around the table, Mike McKee, this one, a couple of seconds late, Mike.
Yeah, well, maybe the computers are thinking it's Good Friday and they're taking a little bit of time to get this done, but we have the number now, and the economists win. 236,000 is the total for the month of March. 230,000 was the estimate, and of course it was 311 last month on an unrevised basis. We're waiting for the revision number to drop at this point. Change in private payrolls, 189. Wow. That's down from 265. So there is a significant government component to this. We'll have to check out what that is. Manufacturing payrolls fall by 1,000. They were down 4,000 in February. The unemployment rate ticks down to 3.5% from 3.6%. That's going to be also an interesting discovery right there. And we're looking at average hourly earnings come in at 0.3. That's tick up from last month, but right as expected, and it puts the year-over-year number at 4.2%, down from 4.6. That is sort of a base effect change, so I don't know how much money credence the Fed's going to put in it in terms of an inflation signal, but it is good news. And average weekly hours come in at 34.4. That's down from 34.5. Labor force participation rate, 62.6 from 62.5. More people working. That gives us a clue as to why the unemployment rate went down. I'll take a look at the rest of the numbers while John leads you through the markets, and I'm sure there's a market reaction.
Yeah, there is, and I'm going to jump in and say this. Tom was right to ask what is the whisper number, because when we talk about 236K relative to 230, that's relative to what economists were looking for. Market participants who had put a bid into the two-year yield, the two-year, through most of this week, off the back of weaker data, were looking for a weaker print, without a doubt about that. Yeah. Yields are up at the front end now by 11 basis points on a two-year to close to 395 on a two-year yield. I will say this, worth noting that things are pretty quiet on Good Friday. So read into these moves what you will, but keep that in the back of your mind. So that's the move in the bond market. Equity futures turning just a little bit higher by 0.1% on the S&P 500. But Tom, certainly that move at the front end of the curve gets my attention. Up 11 basis points on a two-year. Yes, that print is in line, but I would say this, based on the data we've had so far this week, in line is a beat.
Inline, absolutely. Inline's a beat, and you're seeing that in the market, and the correlations are even with the 10-year real yield moving higher as well by 5 basis points. The granularity that Mike McKee's expert at as he digs into pages and pages of data, the underemployment rate, which is really not au courant, but the fact is the underemployment rate gives us a better statistic than last month. That's not what we're supposed to see, as we heard Anna Wong say. This is a chairman that wants a 4.x% unemployment rate. The microdata doesn't show that.
Mike, you got a second look?
Yeah, let's take a look at some of the categories of jobs. Leisure and hospitality helping lead the way this time. 72,000, lower than the average monthly gain of about 95,000 over the last 6 months. Food and drinking up 50,000. They're still trying to fill all the jobs they lost when the pandemic broke out. Leisure and hospitality still 2.2% below its pre-pandemic level. Government employment, we mentioned, that increased by 47,000, but according to the BLS, that's about in line with its average. And here's an interesting thing. There was an article ahead of the jobs report that suggested that we would see a decline in temporary services, employment in professional and business services, and that would be a sign that the economy is cooling off, but instead they go up by 39,000. So that is not, there's not a canary in that coal mine. Healthcare, always a big category, adds 34,000 jobs. That's down from where they were if you want to look at some sort of canary there. And transportation and warehousing has been an interesting one because it went up so much during the years that we were seeing everybody go to internet shopping. Now it changed very little, about 10,000. Couriers and messengers, 7,000 jobs. Those are the jobs of the people who deliver all those packages to you. So it looks like this is sort of a status quo report. Retail jobs were down by 15,000, but not a significant drop given the situation, and that may be the seasonal effects. So as I say, this looks very much like a sort of status quo. Not a lot happened during the month that changed employers' views. We did see in the beige book and in the minutes that people were the last minutes, people were telling Fed officials that they were holding on to workers for right now until they got a better gauge of what was happening in the overall economy.
Mike, thank you. 236 is the number, 230 the estimate, the consensus estimate, the median expectation in our survey. Mohammed, your take on this one?
So 2 comments in terms of implications. One, for the Fed, this increases the probability that they'll go 25 basis points in early May. Of course, the CPI number is going to be important, but given this does not justify a pause given how they've been thinking. Second, it's good to see good economic news in terms of higher labor force participation, in terms of the unemployment rate coming down, being also good news for the S&P, for stocks, which tells you that we are making this transition where the stock market was obsessed with interest rate risk to one where it's concerned about credit risk. And this number here suggests that it should be less concerned about credit risk for the moment.
Randall Krosner with us as well, the former governor of the Federal Reserve, of course, the University of Chicago Booth School. Professor Krosner, when I look at this data and what Dr. El-Erian says about clearly optimistic data, I want you to speak to the optimistic market economists that say there's more going on than traditional economic analysis, that this is an America resilient. How do you see that at Booth School?
Well, this is something we've talked about before, and I've called the so-called immaculate disinflation, that somehow, because inflation is gradually coming down, that we can do this without the labor market cracking, without really feeling much pain. I think that's a little bit too positive. I think people would be a little bit concerned to say, oh, well, we'll just be able to make it all work very easily. One thing that was at least heartening in the report is that the changes in wages seem to be roughly where exactly on where the forecast was. So that's down a bit from where things had been. So we're seeing still a reasonably robust labor market, but not quite as much wage pressure. I very much agree with Mohammed. I think the Fed has been, I would say the Fed's been very clear, and that makes it very easy to say that unless something wild happens in the next few weeks, they're going to go 25 basis points, and then it's likely that they may pause. Obviously, that'll relate to how the inflation report comes out.
Right.
But they're getting into the fives, and that's something that we've talked about for many months. That I think that's where the Fed was going. I think they made it fairly clear that that's where they were going, and they're probably going to pause 5 and 5.5.
Governor Krosner, I look at the 1 million jobs formed off revisions of the last 90 days. The 3-month moving average is 355,000. That is a booming job economy under any theory. How distant is Jerome Powell from his higher unemployment that he desires?
Yeah, so as I said, the Fed's not going to quit until the labor market quits, and the labor market has not yet quit because I think the view is still it's going to be very difficult to bring inflation down in a consistent and permanent way until you see some more weakness in the job market. Fortunately, we don't see wage growth accelerating, but it's not come down nearly as much as
John, this is just extraordinary. I mean, are we back to a Bullard 7% in the last 4 minutes?
No.
I'm looking at 355,000 jobs per month.
Well, here's the interesting thing that happened in the last month. When you look at that household survey, the labor force grew by 480,000, which the Fed has been expecting. More people come into the labor force, and maybe that's bringing down the JOLTS jobs numbers. And of those coming into the labor force, more people got jobs, 577,000, while unemployment fell by 97,000. There was a big dichotomy between the establishment survey and the household survey for a couple of months. It looks like household is now catching up.
236 is the number. We haven't had a downside surprise on a payrolls report in 12 months. Ronnie Krosner, thank you, of the University of Chicago Booth School of Business. Sarah House standing by, senior economist at Wells Fargo. Sarah, you've had some time to pour through this one. What stands out for you?
Yeah, so I mean, I think overall there's a lot for the Fed to like in here, in that we are seeing signs of the labor market cooling down, but in an orderly way. And we're seeing some balance creep back into the jobs market. So whether we're looking at some of the demand indicators we've gotten over the course of the week, but also I think one encouraging aspect here is that you did see that labor force participation rate tick up for a 4th consecutive month. And that's really how the Fed would like to bring the labor market back into balance. So unfortunately, their tools work more on demand, but seeing that supply side is an encouraging sign for that prospect of a soft landing in terms of average hourly earnings cooling, but because businesses have more workers available to them and can continue to hire at a decent pace.
Sarah, is there any kind of disconnect whatsoever between what we're witnessing this morning in this report and what we've seen so far over the last week?
Well, I think overall the payrolls still remain very buoyant compared to the other labor market data that we've seen that I think have pretty consistently shown that the labor market is clearly softening. So you see that whether we're looking at some of the job postings data we saw earlier this week with the JOLTS report, the private sector and Indeed postings. I think the unemployment insurance claims, which showed that, look, the trend over the past year is actually pretty flat, but we've definitely seen it move higher here. So that's kind of the flip side of businesses looking for new workers is how much they're hanging on to existing workers. And so to some extent, I think the non-farm payroll numbers remain surprisingly high against some of these measures, including the PMIs, but I think it shows that, overall the labor market remains pretty strong.
Sarah, let's dovetail your work with Dr. L. Arians. I'm going to ask you a Mohammed question. That's what they're called worldwide, folks. When you ask some fancy Cambridge question of Mohammed, it's a Mohammed question. Sarah House, what is a T decision in front of Chairman Powell as we move not only to May, but to the summer meetings of the Fed? What is the this way or that way decision that Chairman Powell will have to make?
Well, I think it's very much dependent on, do we continue to see the worst part of the stress in the banking system over, where they can focus on inflation and the jobs market. But I think it all still really comes down to inflation, the inflation pressures we're seeing. So we think that the Fed is still on track to hike again in May, in large part because we just don't think we're seeing a convincing downward trend in inflation quite yet. So I don't think they're going to get enough data, and even with the March CPI report, it's still going to be pointing to a pretty strong trend. So I think they're still very much focused on that, probably allows for a hike in May, but I do think they're getting to the point where they're thinking more about those cumulative lags, where you are starting to see some broader softening in the economy, whether it's the jobs market, whether it's some of the activity gauges like the PMIs. And so I do think that gets them still pretty close to the point where they go on hold and wait to see how the medicine takes.
Sarah, can we ask you to focus on the services sector, because that's the one area that may result in much more sticky inflation than anybody would like. How much should we take out of this number compared to the ISM? And in particular, how will that reconcile what is still a very big difference between whether market sees rates ending up this year and what the Fed has told us about where rates are going to end up?
Right, so I think you're spot on in terms of the service sector really holds the key in terms of how fast inflation comes down and whether the Fed is able to pull off this soft landing. So I think there's a lot of disinflationary forces coming through the good side of the economy, just given the spending patterns that we've seen and how much prices ran up. But it is that services side, and I think what we've seen in terms of the hiring numbers, the leisure and hospitality, the fact that you're still seeing some pretty strong gains in professional and business services shows that despite the step down in the ISM services we saw earlier this week, that side of the economy continues to move along. And so I think that's going to be really important in terms of how that market pricing and what the Fed eventually does play out, since that's really the last vestige of inflation that the Fed needs to figure out.
So let me put you on the spot, if I may. Let's fast forward to December. Who do you think is going to end up being right? The market or the Fed?
So we'd lean more towards the market at this point. So we're expecting the Fed to begin cutting in December, as we do see the economy slipping into recession in the second half of this year and the unemployment rate rising to about 4.5%. And so we think in the face of that clearly weakening in economic activity and those inflation pressures continuing to subside, that at that point the Fed does go ahead and begin to ease a little bit. But this isn't a recession that would take the Fed back down to zero. We think this is just moving more towards a neutral policy rather than an outright restrictive.
John, we got to reset here, but can I just point out, is Mohammed auditioning for our jobs?
Have you not seen this happen on the 9 o'clock?
I know.
Oh, he comes on the open and does this all the time. And I tell him afterwards, will you stop asking better questions than that? Sarah House, thank you, of Wells Fargo. Just to reset for you all on TV and radio, if you are just tuning in, welcome to the program. It is Good Friday. The equity market will not open at 9:30 Eastern like it typically does, but we have got some payrolls data for you. The payrolls data reads as follows. 236,000 was the number. The median estimate was 230,000. We have not had a downside surprise on a payrolls report since the March report of last year, which we got in early April. We thought we might get a downside surprise this morning because we've had a series of downside surprises through the week so far. To Tom's point on the whisper number, which you're only half joking about, the whisper number was for a much, much softer number. And what do we mean by the whisper number? Basically, people on markets, not economists, market participants, looked at the data so far this week, saw it was weak, put a rally into the front end of the curve, yields lower on a 2-year, and maybe, I think, Tom, in line this morning is an upside surprise relative to what we've seen so far this week.
Yeah, no question.
So yields at the front end up a little bit. I will say this about the market reaction, though, Tom, and I think it's worth saying. It is Good Friday. There aren't many people around desks doing this stuff.
It is Good Friday right now. We're going to digress here. We have a wonderful effort here for another 15 minutes with Mike McKee dropping, digging into the data as well, and Dr. Al-Arian with us. I want to pause here for the public service of Mohammed Al-Arian, and there's a photo out in his Twitter feed. On radio, it's real simple. It is the students of Queen's College, Cambridge, with the beast Bosa. This is the official dog of the University of Cambridge. And Mohammed, I want to just pause for a bit here, and this is on Good Friday. Now, you studied with Erasmus at Cambridge years ago, and the problem is John Fisher had your job a few years ago, and he ran into an altercation with Henry VIII. You got to be careful at Cambridge when you're there. It's an emotional place. What's been your experience dealing with these students? What's been the biggest surprise of your day job now?
So for those of you who don't know English history as well as Tom does, John Fisher, who was the president of Queens, got beheaded. And he got beheaded by Henry VIII. So look, it's been an amazing experience with the students. I cannot tell you how exciting it is to see them embrace the opportunity that they're giving. And you're seeing transformation right in front of your eyes. I experienced it. So I see it repeated over and over again. Yeah. And it happens especially to people who come from more difficult backgrounds and who recognize that this is life-changing, not just for them, but for subsequent generations.
Tell me about the elites that you're living with, and frankly, we are every day, maybe not at Cambridge, but we're in an elite world. What is your optimism seeing this jobs report of an America that's essentially flat on its back? Half of America is struggling just to get by.
So I do think we have an inequality problem. I call it a trifecta: income, wealth, and in particular opportunity. And I think a lot has to be done to try and level the playing field on opportunity. Having said that, this is not an economy on its knees. This is an economy that's incredibly robust and only gets down to its knees if there is further policy mistakes. I'm actually quite encouraged by how well the U.S. economy has been doing, given what else has been going on in the world.
Well, I just want to point out, because we're talking about inequality in the world, this is a really, really good report for minorities. The unemployment rate for blacks or African Americans drops from 5.7 to 5%, a 7/10 drop in 1 month. Asian unemployment drops by 0.6 to 2.8%, and Hispanic drops by 0.7 to 4.6%. This is only conjecture, but it seems like when you have this kind of continuing improvement in the labor market, it is getting to the people who are last hired, to the people at the lower end of the socioeconomic scale who didn't get the jobs back right away, and it seems to be broadening.
So this is the question that people ask, Mohammed. To Mike's point, the labour market looks okay in this labour market report. Some people might disagree based on other figures we've had this week, but let's just go with this. Why does the Fed want to ruin it? That's the question you often hear asked. Why do they want to ruin this? Why do they want to get unemployment higher? I think a lot of people outside of Wall Street and the Federal Reserve, the institution, don't quite understand that. Can you make sense of that for us?
So the charitable interpretation is because they're not getting enough help on the supply side. And if we did more to enhance labor force participation, they wouldn't have to do so much on the demand side. That's the charitable side. The less charitable is they started very late. And because they started very late, they are having a lot of hikes in a very short amount of time, which then creates more damage to the real economy than you would have had otherwise had you started on time. And I think there's general agreement that they started very late, probably a year late.
The Fed's argument, and I'll take the Randy Krosner side for right now, is that they think they can tighten the way they are tightening because there were so many job openings left over after the pandemic. The people are filling those holes rather than unemployment rising. We saw yesterday the jobless claims numbers, which when they changed the seasonally adjusted factors, went up by about 30,000, but they're still very low and not showing signs of breaking out. There does seem to be also, because it was so hard to find workers, a labor hoarding thing going on where companies are reluctant to let people go. So the Fed is maybe gambling at this point that they can get away with this, but it's paying off.
I'm going to take the Elizabeth Warren side. We've created 1 million jobs in 90 days. You just gave us stunning diversity statistics of the minorities of America prospering. John, is this maybe the best jobs report I've ever seen? 1 million jobs in 90 days in different minority unemployment that I never imagined or framed in my head.
Well, you know what people are going to say back to that, Tom? Just wait. Just wait. Just wait based on the tightening we've had in 12 months, 0 to 5. Potentially in the coming meeting on May 3rd, they go beyond 5. And Mohammed, on top of that, the banking stress, an extra layer of it. I just think there's a big group of individuals right now on Wall Street, market participants, looking at this data point this morning and saying, great, okay, wait a couple of months because it's going to get worse. Is that your take?
That's the fear. That is the fear. And I worry about it every single day. My question for you, if I add up all the numbers you've given us, Hispanic down from 5.3 to 4.6, black unemployment 5.7 to 5, Asian 3.4 to 2.8, that means white unemployment must have spiked higher in a very big way.
Well, I can check that out very quickly here. White unemployment obviously has been very, very low. At this point, white unemployment is unchanged.
Okay, so that doesn't add up. So if everything else goes down and white is unchanged, so
well, you can come with me tomorrow to the Bureau of Labor Statistics.
There we are.
And talk to them.
Around the table here, in a moment, I want to celebrate Mike McKee's work here, talking with the Federal Reserve Bank of Boston, talking to the Federal Reserve Bank of Cleveland, talking to the Federal Reserve Bank of St. Louis. And I want to go back to something. This is, John, so important because it's what surveillance does, and McKee lives every day. And folks, you don't know this, but Alarian on the side is a songwriter. Here's Alarian off of one of his key songs for Hamilton a number of years ago. And the lyrics of this are just important and go really right to the idea of what the Fed will do. Talk less, what? Smile more. Don't let them know what you're against or what you're for. You can't be serious. You want to get ahead. Fools who run their mouths off wind up dead. You wrote about this.
I didn't quite write about that whole thing. But I just want to join you because, Mike, you are amazing. I always listen to you. I end up having, because of you, many more insights than I would otherwise. And the way you interview federal officials and your questions at the FOMC press conference are just terrific. So thank you.
Are they talking too much?
Oh, absolutely, they're talking too much. I think just talk to former federal officials, see how they feel about the amount
well, the follow-on to that they would give you is, would you rather we go back to the days when nobody spoke? And
but that's a false choice. That's a talk less doesn't mean don't talk.
Well, as a president of a college, when you have a faculty meeting, can you tell members of the faculty to shut up and not speak? That's kind of the problem. They got 19 people, 18 at the moment, on the committee, and they're all going to want their chance to say what they think.
If knowing what we know today, would you keep the dots?
No, well, you know, I was just asked that by one of the people I interviewed, and I said no. Not because the dots couldn't be helpful, but because they're not. Wall Street does not read them as 19 different dots based on the forecasts that those people make. They read it as this is our plan going forward.
So Judge Keene, I rest my case.
Judge, John, does the Bank of England need dots? Does the Bank of England talk so much? Does the Bank of England talk to Michael McKee like this?
Can I have my camera, just my single, just for a moment? Mike McKee, you're amazing. It's just my turn. It was my turn. Mohammed, do you think the Bank of England does this better than the Federal Reserve, don't you? Just the communication. Why? What do they do differently?
I think they are less political. They're honest. They say things that may be unpleasant but need to be said. You know, your governor came out and said inflation will go up to 13% if we're not careful. He came out and warned against a wage price spiral. The inflation report was the first to acknowledge that they had made a mistake on transitory. They hiked first. I mean, if you look at what they do, and then they publish fan charts, and they're honest about the uncertainty.
Well, the Fed does publish fan charts.
But the
now.
dots,
Nobody looks at them.
no one looks at them, exactly. Because if you put something else out there, they will look at that. So I do think that there's a lot to learn from best practice central banking around the world, and that we have to have an open mind, and we must not get stuck in this lack of cognitive diversity, because it ends up hurting the American people. It really does.
If I could give you one thing right now, would you take the CPI report next week or the bank earnings? What would you like to know up front?
If I'm worried about the economy, I would take the bank earnings, but more details about bank deposits. I think people don't understand what happens to a banking system when money flows out, not just to the large banks, but to the money market sector. It is significantly different in terms of the propensity to lend. And who gets hurt? Small and medium term industries. And they are major job creators.
Would you like to stay for an extra hour? We can do this for another 60 minutes if you want.
No, I think
all right.
I think I managed the hour. But thank you for having me.
Hey, Mohammed, thank you. Thank you, Mohammed. This was great. And to you as well, Mike. Just awesome. Coming up shortly, Nadia Lovell of UBS, after the payrolls report comes in firmer than expected, 236,000. The median estimate of economists, 230,000. Futures positive, and bond yields higher. From New York, 1 hour to go. This is Bloomberg.
At Lovesac, we design furniture for life. Real life. Messy life. Life that changes and brings us together for movie night. A life where batteries run down and get charged up again. Because now, Lovesac Sactionals can be upgraded with stealth tech and immersive surround sound by Harman Kardon hidden inside. Upgradable, washable, and guaranteed for life. Don't just hear it, feel it at a Lovesac showroom near you.
This is Bloomberg.
Here's your parachute.
Certain it's okay? Are you for imprint certain? Certainty matters, so congratulate coworkers or say thank you with promotional products from forimprint.com. For imprint, for certain.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
There is an awful lot of really bearish sentiment out there.
Fixed income, once again, for investors is behaving as a hedge against falling equity markets.
The bias of risk is that the Fed doesn't ease as quickly.
What has troubled me, and I think what is troubling the economy right now, is the rapidity with which interest rates have risen. That is what is unprecedented.
To get inflation from the levels they're at down towards a 2% path really will take a recession in the economy.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Equity futures right now on the S&P positive 0.2%. Some response in the bond market to the payrolls report from about 30 minutes ago. Yields higher at the front end of the curve by 8 basis points to 391. The numbers that you want, 236K, that was the headline number. The median estimate in our survey, 230,000. Breaking down the report, here's Mike McKee.
Well, John, this was much better than perhaps the whisper number around Wall Street anticipated. As you mentioned, 236,000. We did see the prior months revised down the last 2 months by 17,000, and that 500,000 job month 2 months ago has been revised below 500,000, but 477 is still strong. Unemployment drops to 3.5% as a lot more people come into the labor force and a lot more of them get jobs. Participation rate ticks up to 62.6%, and average hourly earnings come in 4.2%. Where the jobs are, leisure and hospitality gained 72,000 and government 47,000. Those were the biggest categories. But check this out. Goods producing jobs for the first time in many months lost 7,000 jobs, while services added 196,000. It's a pattern we know has been happening, and I could mention that construction jobs also fell by 9,000. Real estate jobs also fell by about that much, so that is one sector that's hurting. And average hourly earnings is your story of the day, really, because it comes in much lower, and on a quarterly basis, and this is Omar Sharif writing in from Inflation Insights, 3.2% for the first quarter as a 3-month seasonally adjusted average, which is just right in the Fed's range for where they think the wage numbers should be to have a sustainable inflation rate. So it has come way down. It was 4.9%, now 3.2% on an annualized basis. So wages coming down, and that is another good news point for the Fed.
So that's payrolls, Mike. Let's shift gears and push forward to the calendar next week. April 12th, the inflation report. I'm just going to go through the headline numbers for you all at home, just a sneak peek of our survey so far. Month-over-month headline, 0.2% is the survey, 0.4 is the previous number. Strip out food energy, what we call core, 0.4 is the estimate, 0.5% the previous number. Year over year, Mike, we're expecting inflation to come down from 6 to 5.2, but for core, to go from 5.5 to 5.6. Similar story in Europe at the moment. Mike, just how sticky is the core inflation story?
Well, it's going to be sticky for a month or two. Then we're going to see the drop in rent levels really hit this number, and it should come down a lot. And that's what the Fed and other economists who think we'll get down to 3.5% by the end of the year are counting on, that we're going to see the real estate numbers drop, and housing will drop significantly as an inflation causer, and then we will have a much lower sustainable number going forward. So we'll be watching that core X housing number that the Fed chairman talks about a lot.
The wonderful Ian Lingen publishing, Mike, and he says flat out, Fed cleared to hike. Do you agree with that?
Yes.
I mean, I know it's not your job.
I
to
mean,
give an
they have
opinion,
their forecast in the dots plot that Mohammed was talking about. The consensus of everybody's view is the median consensus is that they're going to go to 5.1%. So if you think that that's where you needed to go, then you're going to go there, and then they're going to hold, I think. I don't think they go higher than that.
I have to slip this in with the grievous tension that we saw in the last hour with Dr. El-Arian. Are there people at the Fed, Mike, that agree with Mohammed El-Arian that there have been missteps? Is it part of the dialogue within the Eccles building?
No, they do talk about that. They were late getting to it. And an unappreciated fact, I think, is we all look back now and wonder why they didn't stop quantitative easing earlier than they did. And one of the reasons was because of this bank question that some of the bank's assets, they wanted to give them time to reset. They knew they'd have to go up fast on the Fed funds rate. So they wanted to help banks reset. And I've been told they were talking about this whole question of mismatch duration in the banks early last fall.
We've criticised them a lot for groupthink, and I'm totally on board with that. I think it's a problem and something we need to address. But when you go through the summary of economic projections, Mike, I go to 2024 and just look at the range of dots from 3.4 to 5.6, 25, for whatever that's worth, from 2.4 to 5.6. That doesn't sound like groupthink. When you actually look at the range of expectations, It really doesn't at all.
No, it's not. And they will all tell you, nobody really knows what's going to happen. This has been such a confusing time for the economy that they can't put their finger on where things are going to be. And so there is a very wide dispersion for 2024 and 2025. Normally you get that dispersion out 2 years because who knows what's going to happen over 2 years. But we even have that for next year.
2024, just 8 months away. This year's dragging though. I mean, this year feels like a decade already, doesn't it? Q1 and a couple of weeks, a week.
John, you and I don't have jobs. McKee has a real job. You and I don't. Guess what? This is exhausting.
Oh, without a doubt. Without
it's
a
just
doubt.
exhausting.
Nadia Lovell's with us now, Senior US Equity Strategist over at UBS Global Wealth Management. Nadia, wonderful to catch up with you. You've had about 36 minutes to process, digest these numbers. What do you make of them?
You know, I think, Jonathan, the term so far this year might just be the resiliency, not only in the economic data, just given how strong we've had the job market be, that it's really given the consumer the confidence to continue to spend. But I would also say, even in the stock market, despite the volatility that we have seen in the banking sector. But that said, I mean, we are starting to see some signs of crack in the leading indicators as well as the more real-time data, whether you look at ISM this week or some of the uptake in terms of jobless claim. And so those cracks could really start to turn into craters. You also have a market now that's trading at the higher end of its 6 months range, and valuation is quite extended. And so we do think that the market remains vulnerable, particularly as if there's any bad news, that narrative could really take hold. And so, you know, next week we'll get the kickoff of the earnings season. So we'll be watching that very closely. I mean, the bar has been lowered, so maybe companies can indeed beat.
I want to dovetail the economics of the moment, Nadia, with your wonderful work in equities. And I want to center it around folks joining us, I believe, on Monday is Adam Tooze, who is front and center in the firmament of what we're thinking right now. Professor Tooze will join us. And Nadia, he is very much centered on the illusion of inflation on nominal GDP. Is the unspoken surprise forcing us to look at S&P 4100 that we're going to see better nominal GDP, that we're going to see better revenues, and that will make the grimness of earnings shortfalls less?
No, I don't think so. I think that you are going to start to see some softness to the top line, to revenues. You also, companies are struggling to continue to pass on any sort of price increases to their customers. And so we do expect some margin squeeze this year. You know, of course, I do think that the consensus is expecting that earnings kind of trough in the first half of the year and a real inflection in the second half of the year for earnings growth of sort of mid-single digits. But we think that there's just continues to be a risk to the downside as the economy slows. And if inflation does indeed get it under control, I mean, obviously that has further implications for even more pressures on earnings in the back half of the year.
When you speak to your securities analysts, sector by sector, industry by industry, will we see more Federal Expresses with some sharp strategic restructuring?
I think so. You're already seeing a lot of companies tighten their belt and really focus on efficiency. And I think that that's going to separate some of these companies that will be able to withstand an economic downturn as we get into the back half of the year, into 2024. We think that you're going to see more cost control. And so those are the kind of companies that you want to focus on, those higher quality companies that might be able to sort of weather any economic downturn.
The year of efficiency, Meta, year to date, flying. Is Meta one of those companies? I mean, I'm serious, Nadia. I'm trying to work out what is a high-quality company at the moment, what's defensive in the era that we're in at the moment and the conditions we're about to approach. And a lot of people think those conditions get weaker. Year to date, as you know, the leadership has come from tech. The NASDAQ is up more than 15% on the year so far, Nadia. Where do you think the leadership comes from?
We do think that the leadership is going to come from the more defensive side of the market. We actually increase our defensive exposure, even though we have taken down global equities, Lisa prefers in favor of high quality corporate bonds. Within equities, we're more defensively positioned. But we haven't gone full throttle on the defensive side. I mean, we have been favoring consumer staples as well as utilities. We do maintain some cyclical exposure through industrials. On tech, I mean, yes, we've had very strong performance year to date, just benefit from that flight to quality, just given a strong balance sheet within the sector. But reality is, this is a sector that's now trading at a 40% premium to the market, the highest that we've seen in about 15 years. And I think that there's this perception that tech is particularly defensive. But remember, while they have strong balance sheet, their customers might not have the same access to cash that they do and will suffer from tightening lending standards. And that's going to impact demand as well as IT budgets. And then when you look at the real part of tech that's really rallied, it's been the more cyclical part, semis. And that gives us some pause, Jonathan, here.
Hey, Nadia, this was great, as always. Nadia Lover there of UBS Global Wealth Management. Looking at the jobs numbers that came out about 41 minutes ago. 41 minutes ago, we got a print of 236,000. The expectation was 230,000. Got a fantastic lineup of guests for you through the next 50 minutes or so. 9:45 Eastern Time, we'll catch up with the US Commerce Secretary. Before we get there, Robert Tipp of PGIM, I believe he's going to join us shortly, Tom. Anastasia Amoroso of iCapital, and Tiffany Wilding of PIMCO.
Well, it's a strong debate as to get us into this April and after this seismic jobs report. What's next? John, let us reframe here. I'm going to do this off the Standard & Poor's 500, which is a far more accurate index than the Dow Jones Industrial Average. End of year, 3,800. We're not going to go any higher. 4,100, then 4,000. The resiliency of Standard & Poor's 500 at 4,100. No one's modeling out an S&P that can go further.
The range, 38 to 42.
Yeah.
Just held that range now for
Who's modeling a
months.
breakout here? 4,200 to 43. Dare I say up to 4,600? I don't hear it.
Would you like to share the additional programming notice, the Tiger Woods tee-off time?
12:54 p.m. is where Tiger Woods will launch today. It's an emotional Masters. Cold weather scheduled for Augusta.
You're built for this. Do some
I
golf
wore
coverage.
green today. I got sort of like a green jacket on here, just in the spirit of
From New York City on this payroll
The new
Friday.
par 3 is exquisite.
This is Bloomberg.
They put the tee up higher.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Israel strikes back after the most sustained barrage of rockets launched from Lebanon and Gaza in 17 years. Israeli jets bombed Hamas sites in the Gaza Strip early Friday, causing property damage, but no injuries, according to Hamas officials. Israel targeted underground tunnels and sites used for weapons production. Secretary of State Antony Blinken says China wants to have it both ways when it comes to the war in Ukraine. In an interview with the European news network Euronews, Blinken said China is trying to advance a ceasefire proposal while also backing Russian President Vladimir Putin. He added China should be focused on urging Russia to respect Ukraine's sovereignty and to give back to the territory seized by force. In Tennessee, Republican lawmakers have expelled 2 Democratic colleagues in retaliation for their participation in a gun reform protest from the House floor last week. Justin Jones of Nashville and Justin Pearson of Memphis were stripped of their seats in the first partisan expulsion in the body's history. The Democratic lawmakers had addressed hundreds of people demonstrating in the wake of a shooting at a Nashville Christian school. Replacements will be chosen in a special election later this year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We really need to get that life insurance.
Introducing Evie for Ethos. In just 10 minutes, Ethos can help you protect your family's future for as little as $10 a month. Just answer a few health questions and get a quote in seconds at ethoslife.com.
The Omaha Steaks semi-annual sale is here. Right now, we're offering 50% off site-wide. The only number that hasn't changed is our 100% guarantee that you'll love every bite. And if you've never tried Omaha Steaks, save an extra $30 with promo code FIRSTTIME. Visit omahasteaks.com/TV today. Why wouldn't you want to save 50% on 100% satisfaction?
Your record label is taking off, but so is your sound engineer. You need to hire.
I need Indeed.
Indeed you do. Indeed Instant Match instantly delivers quality candidates matching your job description. Visit Indeed.com/hire.
This morning, smile with the rising sun. Three little birds, it's by my doorstep, singing no worries.
If you struggle with mobility, the sturdy and comfortable Hurricane helps you walk on any surface and truly stands alone. It comes with a worry-free 100% money-back guarantee plus free shipping. Get America's #1 selling cane at hurricane.com.
Europe is at the forefront of building a new economy. After a year of war, supply chain bottlenecks, and economic disarray, global leaders must work through the opportunities and challenges facing the continent. On April 19th and 20th, Bloomberg New Economy will gather leaders of government and business in discussion around the most pressing issues facing the European economy: inflation, regulation, supply chain disruption, energy, and cryptocurrencies. Request an invitation to the live event in Ireland at bloombergneweconomy.com.
Next week, Surveillance is live from Washington, D.C. as part of Bloomberg's extended daily coverage of the World Bank Group and International Monetary Fund's spring meetings.
These meetings, even with the banking crisis in place, are really, really important.
Economic outlook, poverty eradication, aid effectiveness, and more.
How slow could global growth get?
You could have a global recession. Live coverage throughout the day starts April 11th on Bloomberg, your global business authority.
For the Fed, this increases the probability that they'll go 25 basis points in early May. Of course, the CPI number is going to be important, but given this does not justify a pause given how they've been thinking.
That was the brilliant Mohammed Al-Arian on with us after those job numbers came out about 46 minutes ago. That job number looked like this, 236,000. The median expectation, 230,000. But you have to do this relative to not just what that number was, but relative, Tom, also to what we had through the week. And what we had through the week was just a series of economic misses. ISM manufacturing, services, downside surprises, ADP, downside surprise. Jobs came in aggressively. Claims started to break out. And I think for that reason, Tom, you've asked the question through this morning, what was the whisper number? What the whisper number really was is, what does the market think is going to happen here? Well, risk is skewed to a downside surprise because of the data we had so far through the week, and that's not what happened here.
I have a hallway at home, John, loaded with books and many, many textbooks, including Samuelson 1948. Where we are right now is not in Samuelson 48. It's not in Mankiw. It's not in Krugman and all the others, Dornbush, Fisher, Stars. This is absolutely, and Dr. Larian, I think, alluded to that. It's absolutely original coming out of the pandemic where we are. And I'm sorry, it's a mystery to everyone.
Just going through some of the notes from Alan Ruskin at Deutsche Bank.
Good.
Here, Tom. Within NFP, he says gains do look heavily concentrated in leisure and health, together plus 123,000. Construction and manufacturing that are more cyclical are softening. The breakdown is then weaker than the headline, but would still argue the data sends a message of labour market resilience, which I think speaks to what Mohammed was saying and others as well. I think you mentioned Ian Lingen of BMO, who said clear for liftoff on May 3rd, right?
And you mentioned this key date, and let's remember, folks, this is the jobs report before the next Fed meeting. They don't get the joy of an April look in the first week of May. Maybe, you know, John, now that I think about it, they may be briefed on that into the meeting. I wonder if they get a sneak peek.
I think there's a risk here, Tom, we move away from banking stress a little bit too quickly. We've got to pay attention to what's developed over the last 30 days or so.
We'll have to do another hour here. We're going to have to go past 10 a.m., John, if we're going to talk about banking stress.
I'll give that a miss. We can come back on Monday and do it if you want. We can do it now with Robert Tipp, Chief Investment Strategist at PGIM Fixed Income. Robert, great to have you on the programme. Welcome, and brilliant to see you as always. Let's start with payrolls and then we'll get to markets. Just your thoughts on what we saw 50 minutes ago.
Yeah, this is a great number. I mean, there are a lot of questions, and you're touching on all the key points, but this has been a red-hot economy, creating so many jobs, creating upward wage pressures. That was giving the Fed pause. We're seeing moderation in the pace of job growth. And as one of your earlier guests pointed out, that's what we've wanted to see. But it's also something that people now are fearing. You know, is it going to dive into a recession? And I think what you were mentioning there about travel and leisure, there are too many areas of this economy within consumption that are too firm, in my mind, to ultimately derail this expansion. But that's going to be an open question for a few months. And, you know, we could be in for another month of misses as the Fed pauses, skips a meeting. I believe they should do that. They hadn't really planned on having that many moves this year anyhow. You'd think they'll be more patient. That should be a tremendous market.
Robert, I want you to speak to the people on radio and television trying to get into April, trying to get to summer. And the rationalization is I can buy a new higher coupon and I can wait even if price goes down and yield goes up. Is that a PGIM core idea, that the coupon now is good enough where I can take a bigger participation in fixed income?
It's not a belief. It's not a mystery. It is a fact. When we were in an environment, 2012 to 2020, with an average 2% or less 10-year treasury, your goalposts for kicking a field goal in fixed income were about that wide. And over that 10-year period, you could do it. You had a positively sloped curve. You had a lot of alpha opportunities. But now we've adjusted, and things have really changed. I mean, the goalposts were pretty wide for equities in a low real yield environment, and that's flipped. Now the goalposts for equities are pretty tight. Growth is slow. Real yields are higher. Bond yields are attractive. As you're pointing out, when you have a big fat coupon, if you're in it for the long run, if you're going into high yield or you're going into diversified fixed income, or even the first handful of years of the corporate bond market, your odds of success are pretty good.
When I look at the total return index, it's had a really nice recovery. We talk about, chart formations in the equity market. In the bond market, are you seeing a chart formation that says price up, yield down?
Well, I think what we're going to see is yield range bound, returns high. And we've just seen the second quarter of that. So I'm perfectly willing to dive into the payroll numbers and want to, split hairs, but you have to see, progression of months. You can't jump on a single data point. But basically, the long end of the yield curve has been very stable, especially so on long spread product, where there's been an inverse correlation between spreads and yields. So in other words, treasury yields go down, spreads widen. The long-term general fixed income yield is banging around much less. And yield fluctuations are really steep at the front end of the curve. We've seen a 200 basis point range, say, in your expectations of where the Fed funds rate is going to be, 6 to 12 months from now. But at the back end of the curve, for the long bond, it's been fairly range bound. So this bull market that we've started 6 months ago is going to be one where rates remain kind of high and range bound, and people earn their money by clipping the total return and looking for alpha opportunities within the market.
Robert, where does that leave the credit call now for you and the team? What have you and the team been doing over the last month as this banking stress started to come to the surface?
Yeah, well, I think that, could there be an economic sudden stop? Could there be troubles for credit? Could you finally have the recession? You could. But looking from the bottom up, there are way too many credits where the outlook is fairly stable and the spreads look attractive relative to the underlying risks. So I think on a 12 to 24-month basis, you're going to end up seeing strong returns, whether it's from high yield, hard currency emerging markets, or from your intermediate investment-grade corporates or structured products. But it's going to be a noisy 6 months as we wait to see exactly how much slowdown do you get. But slowdowns can be very good for spread product.
Robert Tipp of PGIM, thank you. Robert Tipp there with a more constructive view, Tom. But just pushing out the timeline just a bit longer and taking a more constructive view of things right now.
This constructive view, and this goes to, in another world, it goes to Neil Dudd at Renaissance Macro and other, I'm going to say, optimists that are out there. It's just so easy to be gloomy now, and given the uncertainty, and I mean almost a theoretical uncertainty, boy, gloom comes easy. And, I'm making jokes. I'm talking about the whisper number.
Sure.
But John and I know, and McKee lives this is serious stuff. And people were really skewed gloom. And once again, this confounds the chairman of the Federal Reserve. And there you go with another rate hike. People are going, why? We're all going to die with another rate hike.
Well, you've got to ask,
says who?
You've got to ask, why is it so easy to be gloomy right now? It's so easy to be gloomy right now because unemployment's at 3.5%. And there's a belief that there's only one way it can go from these kind of levels, Tom, and that's higher after 12 months of tightening and put the banking stress on top of that.
I want to squeeze this in, John, with Anastasia coming up. The levels of the equity market now, and our guests today have alluded to that. 4141 SPX, 33.7 rounded up, 34,000 on the Dow. And to me, the NASDAQ is an act of God. It is 13,184. There's no way, John, when you penciled out your March 31 outlook in December 31, that you and I were looking for that. How's that tour going with your outlook?
For goodness sake, how's the annual outlook going from December, November, October time? I think we've had 3 different narratives, Tom, in 3 different months.
Oh, we have. And it's
soft landing, no landing, hard landing, just like that.
And it's
One quarter.
The new volatility that's out there. You start praying we're going to have less volatility in April, less volatility in May. It's going to be quote unquote normal. I see no indication of that. I need proof that I will see that.
Can we just reconfirm? No opening bell in 4 minutes. The market's closed.
No, we're going to have an opening bell for Gina Raimondo.
Some muscle memory there that may be.
You ever been to Rhode Island?
Yes, of course.
Yeah, okay. Yeah, it's lovely. Gina Raimondo.
Newport?
Governor Raimondo is Newport. Yeah. Yes, they have bars.
Many.
The first time your sales reached 100K with GoDaddy was also the first time your profits left you speechless. At the counter or on the go, save 20% with the lowest transaction fees and keep more of what you make. Start saving today at GoDaddy.com.
Get your slip-ins, just step in and go.
Maybe we should just stay in.
Easy to take off, too. You don't even have to bend over.
Wait, let's go someplace fancy.
They also come in Max Cushioning for ultimate comfort. Try new Max Cushioning hands-free Skechers slip-ins.
It's time to look at financial services in a new way. Time to reimagine what's possible. And Irish companies are doing this every day, delivering innovation that improves customer experience and payments, strengthens security and compliance, and makes the digital workplace work. Enterprise Ireland connects you with world-leading innovation so you can reimagine what's possible for your business. Enterprise Ireland. Connect with Irish innovation.
Also, misleading search results can negatively impact your life. A bad online reputation can put you at significant risk of losing job opportunities or new customers. Reputation Defender helps clean up your search results, wiping away negative first impressions, allowing truthful, positive content to rise to the top. Don't you deserve to have more control over how you're represented online? Get your free reputation report card at reputationdefender.com or call 1-877-866-8555.
Europe is at the forefront of building a new economy. On April 19th and 20th, Bloomberg New Economy will gather leaders of government and business in discussion around the most pressing issues facing the continent. Request an invitation to the live event in Ireland at bloombergneweconomy.com.
All right, team, we got a big project coming up. And it all starts with ordering promotional products.
I'm on it. 4imprint makes it easy to get the logoed products you're looking for. The latest in apparel, drinkware, bags, high-tech items, and more. You can be certain of getting it right at 4imprint.com.
Come on out. I'm on it.
4imprint for certain.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Live on TV and radio from New York City. Good morning to you. This is Bloomberg Surveillance, a special edition on a market holiday off the back of some payrolls data from 60 minutes ago.
Why is it a special edition? Because the Sanka's not coffee? We had Sanka brought in today, folks. It's not our normal Greg coffee.
Special is the word that I would use to describe the show quite often, sometimes for the wrong reason. 230K was the median estimate. 236 number is the number we got. Let's look at the market action off the back of it. Some market action out there. It's in the bond market, actually. If you look at treasuries, 2s, 10s and 30s, the 2-year yield, Tom, off the back of this just higher by 11 basis points. And I think some people might be asking why. It was in line with expectations. It was in line with the survey. When we say expectations, I think we need to be a little bit more purposeful and precise. What the market was looking for was something weaker off the back of a string of weaker than expected data so far this week.
So
and this move speaks to that.
We recalibrate for Monday, and then we'll go to Washington for the IMF meetings Tuesday, Wednesday, Thursday, I believe we're there Friday. How do we recalibrate off the weekend notes this dreaded R-word recession? I mean, I have no idea how you rewrite about it after this jobs report.
Longer variable lags of a banking shock. Keep going back to that phrase, Tom. We've only just gone through it. Yeah. It's only about a month old.
Cumulative.
Not even. Then you've got the cumulative tightening of the last 12 months on top of that, Tom. So you've got 0 to 5% on Fed funds. We'll go through 5. That's what people expect to happen in early May. 0 through 5 in just a little bit more than a year. Throw on top of that some banking stress, which many people believe will lead to tighter lending standards. And there's a belief that, yes, this data is good this morning, but ultimately it will get weaker. Now, the problem you'll have with that, Tom, and many others will as well, is we've been saying that now for the best part of 12 months.
But we didn't have a banking overlay, and the fact is the 4 big banks chart on radio, I've got my finger out level, and every other bank, KBW, X, whatever, is trending down. As Mohammed said, those earnings reports are critical. We look forward to it.
I'm with you. Yeah, First Republic on Thursday, so the 13th, and JP Morgan on the Friday. Tom, it's too soon to really know what that banking stress is going to do to credit conditions.
Yeah, we're going to get more of that
directionally, I think you can make a call. Directionally, but I think magnitude, just way too soon to make that call. To what extent things will get worse.
We'll have to see. Future. I love that. I'm quoting futures here. The market's open. Excuse me. I shouldn't be quoting futures here.
There is no market open. You know that.
There's no market.
You know that. You know that.
Here we are. Have another Sanka time. Okay, right now saving us, Anastasia Amoroso, Chief Investment Strategist at iCapital. And what's magnificent about her notes is there's always a phrase where I just stop and say, how'd you get out front of that? Anastasia, you absolutely nailed it. Pre-trading the recession. That's what we're all doing right now. We're pre-trading the recession.
That's right, Tom. I mean, that's what this whole week has been about. I mean, we started the week, maybe soft landing. Then we had this question in the middle of the week, is bad really bad? And then some of the headlines, as of yesterday, were here we are headed for a hard landing in a recession. And I think it's doing exactly that. It's pre-trading and saying that it's imminent. And I think what the payrolls report today really confirms, it's a positive surprise we needed. The recession is not imminent. And as long as the unemployment rate is at 3.5% and consumers are getting 4.2% more year over year in their wages, there is no imminent recession. Consumption is going to go on. And I think, Tom, you're right. You said this earlier, that there's so much gloom out there. And whether you look at market consensus, whether you look at the move, what's priced in the front of the curve, whether you look at what the economists are calling for, they're calling for 0% consumption. But my point is, this economy is slowing, it's cooling, but it's not cratering. And so therefore, I would not just yet pre-trade a recession.
I mean, the Wall Street Journal, I believe, is on the left column here, talks about the gloom in equities, the lack of participation in equities. How does the stock market lift the way it is? SPX up 7%, NASDAQ up, I don't know, 10, 15, whatever number percent it is. How does the market lift if everybody's so cautious on equities?
Well, I think people may have to go into chasing mode, Tom. I think that's what sort of propelled the rally so far year to date, because everybody came into the year so gloomy. And when I look at the positioning today, it is still quite gloomy. You look at the systematic trade and the net long exposures for the S&P are really at rock bottom levels. The same for tech. If you look at mutual funds that have been underweight technology, for example, and so all the cohorts of investors are greatly underweight, but that means if we manage, you mentioned some of the levels before, Tom, if we manage to hang around these current levels and maybe move a little bit higher, a lot of people are going to find themselves having to buy, being forced to buy. And so the question then becomes, what is the fundamental reason for people to buy? And I think it's going to be the first quarter earnings season, because once again, people came into the year expecting 0% GDP growth. Instead, it looks like we're getting 1.7% in the first quarter or so. And earnings estimates have already been drastically marked down. So I think the earnings season might actually be the positive surprise that people are not expecting.
So number one question then, Anastasia, we've had this range of 3,800 to 4,200 for the best part of this year. You think we're breaking out of that to the upside, not to the downside?
Near term, John, I do think that we might actually break above 4,200. And, I say that because the economy is not cratering and it's actually surprising to the upside. I mean, also look at China. It's already seen a rebound in the first quarter, but in the second quarter, consensus is looking for 7.4% GDP growth. So we might be going into the next quarter with even stronger economic data. So, you put all of that together, and I think that's the market that can continue to break out to the upside near term. At some point, the concerns about recession will have to surface, but for the meantime, the markets are looking for the Fed pause. If the Fed pauses historically, Tom and John, the markets have rallied quite strongly in the next 3 months, 6 months, and 12 months. And again, that's why, if the tightening phase is over, which is kind of produces the worst returns outside of the recession, then the next phase after that can actually be pretty good for market returns.
Can we just dig deeper into the leadership question, Anastasia? Where you'd expect leadership to come from within the equity market?
I am sticking with the NASDAQ trade, John. And, the reason for that is if you think about what was the sector that was hit the most as the Fed hike rates from 0 to 500 basis points, of course, it was the technology sector. It was the reset in valuations that had to happen. But if that reset has been done and we're not going to have the same headwind to multiples, that's a really meaningful thing for tech. But of course, you can't just invest in something just because multiples or now expect to stay stagnant. You invest in something because you expect growth to come out of that sector. And that's where I would continue to see growth as we see a slowdown in industrials, maybe some slowdown in consumer. Guess what's not slowing down? The race towards artificial intelligence, the race towards adoption of more cloud computing, the race, that requires a whole lot of semiconductors. And so that's why when you look at the growth prospects for the NASDAQ, for the tech sector versus the S&P, the tech trade actually should outperform based on those earnings expectations.
Certainly outperforms this year so far. Anastasia, this was great. Thank you. Anastasia Amoroso there of iCapital on the equity market. Year to date, the NASDAQ up by more than 15% after getting crushed last year. Some of these big tech names bouncing back in a big way. If you are just tuning in, welcome to the program. Live on TV and radio from New York. Just a special program for you to bring you some of the jobs numbers. A little bit earlier this morning, 236,000. The median estimate was 230,000 off the back of, let's call it an upside surprise on payrolls. Yields higher at the front end of the curve and right the way through the curve as well. The 2-year out to the 30-year. On the 2-year, up 13 basis points. Your yield right now, Tom, 396 on a 2-year this morning, and quite a trip. So far this week, we've gone from 4.1%, had a look at the 360s, come back to 396. Tom, this year's been nuts. We mentioned it earlier on this morning. Jim Bianco, Jim, thanks for watching the program. Thanks for listening, of Bianco Research.
Bianco's watching us now?
I believe so, because he's echoed what I mentioned a little bit earlier this morning, Tom. January, soft landing. February, no landing. March, hard landing. What's April going to bring us? It's only just started.
This is the zeitgeist, and Bianco, frankly, has led here. There's 2 levels here. I'm not going to go into it right now, but on economics, it's led by Adam Tooze, Adam Posen, Mohamed El-Arian, and others on what are we going to do with inflation sustained and nominal GDP. The rest of it is over to Bianco and markets, and he has led here, John, on what Lisa's talked about, which is this new 5%. And that's really where we are, is a center tendency on CDs, money markets, up by 5. And then this, I mean, John, with the market open now, the Dow's at 33,723. Are we going to get a 4% yield before you and I go out and find our Easter baskets?
Just jump in? Tom's joking. The market's not trading today. There was no opening.
It's not?
There was no market open. You know this. You know, that's a different question. That's a different question entirely.
It's not open?
No. Equity futures were earlier, and the Treasury market is.
I put in a buy order in Hershey's.
Cash Treasuries. What you buying? Chocolate.
Yeah.
What are you buying?
What's what you do in Easter? You put
Easter
a buy order in Hershey's, and you know. I mean, the American tradition here of the kids. What's great with the kids, John, is they get the jelly beans when they're 2 or 3 in their mouth, and they look like chipmunks, like
a hamster.
Yeah, like a hamster, and then they go out like a gun across the living room carpet, and they ruin that, and then they're sick for the rest of the day.
Okay.
It's an Easter tradition. Is it like that in England?
Yeah, you'd get a lot of Easter eggs. You do a hunt and all that stuff, yeah.
Yeah, okay.
We'd hide them in the backyard.
Very good.
And you go look for them. Why are we doing this?
Because it's the tradition. We're talking,
okay, great.
We're talking about
good.
It's Good Friday, and, you know.
Well, happy Easter. Thanks for being with us. Welcome, Tom. Welcome. TK, let's go through the data. 236 was the number this morning, but you just go back on the totality of the data, Fed's phrasing, forgive me, over the week so far. ADP was a miss. Jobs was much lower than expected. Jobless claims yesterday morning broke out.
People were talking
ISM manufacturing services, not great at all. And all of a sudden it's, okay, nothing to see here, payrolls look good.
But then at 60,000 feet, the IMF taking global growth, which I believe includes the American economy, down 21%, a 5-year view from 3.8% down to 3%, and clearly the rhetoric from Dr. Georgieva was a lower number. John, that's the overlay of the global caution with the data we saw this week, and this jobs report says simply wait another 30 days.
What happened to the global enthusiasm of 60 days ago? China's reopening, Europe's doing great, international equities is where you want to be. Do you remember that? That was the consensus, 60 days ago?
Yes. Yeah, and frankly, I would say there's a school of thought that Europe is outpacing America right now, particularly in terms of wages and health of the labor economy. I don't know where that's going to sit in May, but that's where we are right now.
Very shortly, we'll be joined by the Commerce Secretary. Looking forward to that conversation. There is no equity market open this morning, at least. I can talk about the bond market, though. Your 2-year higher by 13 basis points, the 396.39, off the back of a better-than-expected jobs report in America this morning. From New York, good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Russia may quit the Ukraine grain deal if obstacles in the way of Russian grain and fertilizer exports aren't resolved within 60 days. That's according to Russian Foreign Minister Sergei Lavrov, who spoke in Turkey today. Despite Lavrov's comment, Russia is forecast to be the world's largest wheat exporter in the 2022-23 season, and its export prices have become the de facto global benchmark. Taiwan officials say they still expect a visit from U.S. House Speaker Kevin McCarthy. McCarthy met Taiwan President Tsai Ing-wen earlier this week in Los Angeles, stressing the importance of the relationship between the two sides to economic freedom, peace, and stability in the region. The location was apparently chosen to avoid a repeat of the tension seen in August when Nancy Pelosi became the first sitting House Speaker in 25 years to visit Taiwan. Tesla is slashing the prices of all of its vehicles in the U.S. It's an effort to shore up weakening demand for its electric vehicles as CEO Elon Musk vows to chase volume over profit margins. Price tags have been trimmed by $1,000 to $5,000. And Toyota says it will release 10 new EV models by 2026 and sell 1.5 million battery electric vehicles a year. It's part of the company's pledge to have emissions by 2035 and become carbon neutral by 2050. In his first press conference, Toyota's new CEO, Koji Sato, stopped short of giving concrete steps about how the company will match its EV rivals abroad. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
never expected that my sunroof would have cost me $1,600. Thankfully, I had insurance and it was covered.
I saw the bill was over $1,200. What I paid was the $100 deductible.
As a mechanic, I always recommend my customers have an auto protection plan. You never know when a breakdown can strike, and you need coverage you can count on.
A broken AC unit costs over $1,800. Transmission, over $3,000. And an engine, over $4,000.
In the lifespan of my policy with Endurance, I've had 5 claims. That is $3,500 that I've kept in my pocket.
Call now and we'll upgrade you to an Endurance Elite membership free with thousands of dollars of benefits at no extra cost. We offer affordable down payments, low monthly plans, and a money-back guarantee.
So don't drive another second without total protection from Endurance.
Call 855-941-6562 for a free price quote. That's 855-941-6562.
If you're an independent business, get HoneyBook and manage your proposals, contracts, invoices, and payments all in one place. Join the independent businesses already managing their client flow with HoneyBook, so business flows your way.
Asking the right question can greatly impact your future.
Are you qualified to do this?
What? Especially when it comes to your finances.
Are you a certified financial planner?
I'm a CFP professional.
CFP professionals are committed to acting in your best interest. That's why it's gotta be a CFP.
The Omaha Steaks semi-annual sale is here. Right now, we're offering 50% off site-wide. The only number that hasn't changed is our 100% guarantee that you'll love every bite. And if you've never tried Omaha Steaks, save an extra $30 with promo code FIRSTTIME. Visit omahasteaks.com/TV today. Why wouldn't you want to save 50% on 100% satisfaction?
Starting to see some signs of crack in the leading indicators as well as the more real-time data, whether you look at ISM this week or some of the uptake in terms of jobless claim. And so those cracks could really start to turn into craters.
Nadia Lovell there of UBS. Wonderful to catch up with her. Fantastic lineup throughout the whole of this morning. Thanks for choosing Bloomberg TV and Bloomberg Radio, for going on this adventure on a Payrolls Friday, on a Good Friday. Payrolls Friday churns out this number, Tom, in the United States, 236,000. We were looking for a number of something like 230K.
Savannah's correction, Mike McKee corrected me. I did the math. Yes, we created over the last 90 days over 1 million jobs off non-farm payrolls, average 345,000. John, in any time pre-pandemic, that is a sterling 90 days.
The last time we had a downside surprise on payrolls, Tom, March of last year. We got that report in early April.
Well, a major shout out to the optimists that are out there right now. We've got a really strong end here to our morning. We want you to stay with us on radio and television. We're going to get market economic analysis here and scheduled to be with the Secretary of Commerce here in moments. Tiffany Wilding now with PIMCO. Thrilled that she could join us this morning. Tiffany, what was the distinctive feature for you of this jobs report?
Well, I mean, I think, obviously the payroll number on the surface was very strong. And as you mentioned, the 3-month moving average is well above, kind of what we need to sustain the level of the unemployment rate. But if you look at the wage numbers, I actually thought that was kind of interesting because on a 3-month over 3-month basis, average hourly earnings is decelerating. We were at 6 and now we're at 3. That's much closer to the Fed's target. So, I'd say actually overall, this payroll report, even though we're talking about recession and things like that, at least this payroll report was very consistent with the soft landing view that the Fed has.
The soft landing view that they have means, I guess, there's no fear of a 25 beep lift. If they lift 25 more basis points, who is damaged?
Well, from an economist perspective, 25 basis points isn't really a lot, right? It's really all about, the 5 percentage points that have increased, over the course of the last year that really matters. And ultimately, we've talked a lot about long and variable lags. That, in our view, is impacting the economy. And I think that the banking stress that you're seeing, or that we have seen, is kind of symptomatic of those long and variable lags and the fact that monetary policy conditions are tight. so I would say that, as everyone knows, the labor market does tend to lag. You do see growth decelerating first, and we think that is happening and will continue to happen. And then eventually labor markets will also decelerate more as well.
Tiffany, is there a point on the calendar where you'd be comfortable saying that's about the time I think we should recognize just how much credit tightening we'd expect off the back of the banking stress of the last month? When are we going to find that out?
Yeah, we are starting to see it, some of the higher frequency data, that lending growth is slowing in some of the regionals. Obviously, the deposits are moving out of some of the mid-size and smaller banks. And, I think overall the cost of capital for those mid-size and smaller banks, as for everyone else, is going up. And so that's just going to make loans, less attractive for them to make. But overall, I just take a step back. We've done an analysis just looking over 14 developed markets over the past 70 years around tightening cycles. And what that suggests is that after a central bank starts hiking interest rates around 4 to 8 quarters after, you tend to see a more material deceleration in the output gap and in growth. So that's kind of lining up with what we're seeing. It's maybe suggestive that in the second half we actually could see some more deterioration.
Tiffany, this was wonderful to get your view. Tiffany Wilding of PIMCO, in on a holiday. We appreciate that. Tiffany,
all of our guests.
Thank you very much. 236,000, the jobs number, Tom. 230K, the estimate.
And now a conversation, as we do, with someone who works 365 days of the year. She is the U.S. Commerce Secretary, but far more the former governor of Rhode Island. And what is so important within the stereotype of our politicians removed from the labor economy? That is not Gina Raimondo. The Commerce Secretary joins us now with the experience of the collapse of the Bulova Watch Company in Rhode Island. Oh, Gina, I lived it with you. You lived it in real time with your father. There's an awful lot of America feeling they're living the Bulova Watch experience right now. How does the administration speak to those that are not prospering?
Good morning. Good to see you. Well, first of all, the administration is speaking directly to those people because the president is obsessed with bringing more manufacturing back to America. In fact, I was with the president last week in Hickory, North Carolina, a town just like what we're talking about. And I was there because of expansions of 2 American companies making fiber optic cable because of our initiatives to provide every American broadband. So, the president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers. This is an excellent jobs report. Mm-hmm. You're seeing record low Black unemployment. You're seeing record low unemployment among people who have been left behind. And the best news for me is higher percentage of people working in the workforce anytime in decades. So we're going to middle America. We're going to folks like my dad who were left behind in the collapse of manufacturing, and we're getting them back to work.
That's the message to middle America. Secretary Raimondo, what's the message to the Europeans as you do this?
Work with us. I'm headed to Europe at the end of next month. We need to work together. And, I think whether it's the IRA or the CHIPS initiative, there's opportunities for European companies and opportunities for us to work together to meet the moment with climate change and our global competition with China.
Perhaps I should have been more precise. European companies will invest in the United States. What's the message for European governments who are perhaps unhappy about what's happening at the moment?
It's the same message. I understand that there was some initial concern about the IRA in particular, but I'll tell you, we are in constant contact with our European colleagues, including me. I've met with numbers of them and from Germany, from the EU in the past couple of months. I think they're now understanding that there are opportunities for them. And by the way, we all need to do more to combat climate change. So initial hurt feelings maybe, but there's a lot of good work to do together.
Let's talk about what's happening with supply chains. I know this is very important to you. Adam Posen of the Peterson Institute said the idea that making everything domestically built resiliency is, quote, the fallacy of self-sufficiency and has been disproven repeatedly. How would you respond to that?
He's right. Nobody thinks we should be making everything that we need in America. Nobody's saying we should be self-sufficient. It's a global economy. We want to continue to trade. But in the case of semiconductors, for example, which are essential to our national security, the fact that we buy 90+% of our leading edge chips from Taiwan is also unsustainable and, quite frankly, almost dangerous. So no one would say we need to make enough chips in America for all that we consume. That would be silly. But we do need to have more resiliency.
Madam Secretary, I spoke to the managing director of the IMF yesterday, and it could have easily been a 110% conversation on China. You are gifted in that you have Elizabeth Economy advising you, arguably our best young China expert in America. What is Dr. Economy advising you on about improved China-U.S. relationships?
Well, I am smiling because Dr. Economy is about to get on a plane and head to China. What we are doing is pursuing the policy of protecting and promoting. First and foremost, we have to protect the United States of America and our national security. And we're doing that with gusto, with our export controls and guarding our leading edge technology. Having said that, where it makes sense, we need to promote, we need to export, we need to help American businesses and make sure that China provides for a level playing field. So that's the administration's strategy. You are correct that I am extremely lucky to have Liz. She's extraordinary, and she's here in the Commerce Department.
There is no level playing field. There is a lack of reciprocity when it comes to things like social media and tech. Secretary Raimondo, do you think then that we need to start banning more things here in the United States?
There is a law called the Restrict Act weaving its way through Congress. The chief architect is Senator Mark Warner of Virginia, which I think is excellent and is very sensible, which is to say, I do not think we should get into a witch hunt sort of environment where we go after individual companies by name one at a time. I do think, which is what this law provides, is more tools to the Commerce Department for constant, surveillance, ability to investigate and then perhaps regulate companies.
This is a conversation that we're going to continue to have. Madam Secretary, this was fantastic. Thank you.
At the CSE, we're always invested in public markets, in business, in growth, in you.
Is your credit score getting in the way of the things you want to do? Personal loans through NetCredit offer fast and flexible lending. Borrow up to $10,000 and choose repayment terms that work for you. You may even be able to build your credit history as you repay. NetCredit, a more personal loan.
At Morgan Stanley, old school hard work meets bold new thinking. To help you see untapped possibilities and relentlessly work with you to make them real.
You founded your kayak company because you love the ocean, not spreadsheets. You need to hire.
I need Indeed.
Indeed you do. Indeed Instant Match instantly delivers quality candidates matching your job description. Visit Indeed.com/hire.
Go. Go brain. No, not that one. Go this one. Go optimizing data. Go efficiency. Go results. Emerson's Plant Web digital ecosystem is the brain for smarter, safer, and more sustainable performance. Go Plant Go. Go boldly. Emerson.
False or misleading search results can negatively impact your life. A bad online reputation can put you at significant risk of losing job opportunities or new customers. Reputation Defender helps clean up your search results, wiping away negative first impressions, allowing truthful, positive content to rise to the top. Don't you deserve to have more control over how you're represented online? Get your free reputation report card at reputationdefender.com or call 1-877-866-8555.
Different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store. so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
This is my kitchen table and also my filing system. Over much of the past 3 decades, I've been an investor. The highest calling of mankind, I've often thought, was private equity. And then I started interviewing. While I watch your interviews, I know how to do some interviewing. I've learned in doing my interviews how leaders make it to the top.
I asked him how much he wanted. He said $250. I said, fine. I didn't negotiate with him, and I did no due diligence.
I have something I'd like to sell, and how they stay there. You don't feel inadequate now because being only the second wealthiest man in the world, is that right? One of the most interesting and significant philanthropists today in the United States is Laurene Powell Jobs. The widow of Apple founder Steve Jobs, she's using her considerable fortune today to remake the world of philanthropy in areas such as immigration reform, education access, climate change, and healthcare. I sat down with her in her offices in Washington, D.C. to see what unique approaches she's using to each of these philanthropic endeavors. So in recent years, you've become one of the largest philanthropists in the United States, but you've done largely this by anonymity. It's not well known what you're supporting generally, and you try to stay in the background, I think. So why do you try to do your philanthropy this way?
Often what happens, David, as you know, with philanthropy is that there's a lot of power that accrues to the giver and not as much to the organizations and the leaders that are doing the work on the ground. And so I wanted to make sure that we were not the story, that we were supporting people who were the story, that the leaders and the incredible workers who are doing day-to-day work to improve the lives of other humans were actually in the front and we were in the back. And I didn't ever want there to be the emphasis on me as a donor or on Emerson Collective as a donor as much as the work that's being done on the ground. So we started off as almost entirely anonymous donors and givers. Over time, at the behest of the organization or the leader, sometimes we will be in the front. Of course, if you're supporting nonprofit journalism, that has to be publicly acknowledged. So there are plenty of times where we are happy to acknowledge that we've made a gift or a donation or what support over a long period of time, but that's not how we want to lead.
So you do your philanthropy largely through Emerson Collective, LLC.
Yes, that's right.
Why do you use an LLC rather than a foundation or nonprofit foundation, which is what people typically do?
Yeah, it's true. From the beginning, I always felt that I didn't want to be encumbered by a foundational constraint. My intent was always to deploy capital as smartly and usefully as I possibly could. So to find the highest and best use of the next dollar. And so I thought I could always hold off and form a foundation if it turned out we were only going to be philanthropists as a group. But I also wanted to use other methodologies for positive social change, like investing in entrepreneurs and in companies, and perhaps using advocacy and artists and supporting movements and practices and perhaps young emerging leaders who didn't have a C3 yet. And so I kept that level of ultimate flexibility and nimbleness, and it served us really well. I think the other issue that's really important to note is I came into philanthropy and Emerson Collective as a broader practice from the vantage point of not wanting to accumulate wealth. And so my intention is to deploy resources and assets as effectively as I can. And so I didn't need any kind of tax preference for the dollars.
So a number of the areas that you focus your own philanthropy on are, I think, worth talking about for a moment, why you're interested in them. One of them, for example, is immigration. What makes you so interested in immigration reform, and why are you spending so much of your time on that issue?
I'll back up for a second. The organization that I founded and was running in the beginning is called College Track. And I started College Track in East Palo Alto, right next to Palo Alto, California, because I had visited a high school class. I had been invited to speak to seniors who were first-generation college-bound seniors. And the entire class was from East Palo Alto. And despite the fact that they were intending to go to college, I found very quickly that none of them had taken the SATs. Very few had ever been on a college campus. We were in the fall of their senior year, and they hadn't received any guidance. So rather than have a one-time visit, I promised to the class at the end of the hour that I would come back every Friday afternoon, and I would be their college counselor. And that realization, that experience changed my life. So I started then with freshmen in high school. And by their senior year, I discovered that many of them didn't have a Social Security number. And these were students who were fully American, they were raised as American, but they were brought here as toddlers and very young, and they didn't know that they were undocumented. This was in the early 2000s, before people were talking about the DREAM Act and before people were talking about undocumented students. So I immediately started learning about immigration law and immigration standing so that I could serve the students and their families properly. And we started advocating for the passage of the DREAM Act, because what I learned was that this was not an isolated rare case. And so we built out at Emerson Collective a bit of a much deeper understanding of the issue, but a bit of a muscle around how do we actually work with municipal, state, and federal government to try to clarify this, to try to bring some common sense solutions to this, because every single one of us is either a direct or a descendant of an immigrant, and the whole nature of the American dream is to come here for economic and social mobility and to activate our own potential. And so for us to be blocking that for people right now in our lifetime seems like something we need to all devote our time and attention to.
Another area that you're interested in is climate change, and that's an area that many people are focused on. What do you do in climate change that tries to bring your particular expertise and interest to the subject?
We have what's invested in what's called the Elemental Accelerator, which is an accelerator for young companies who are typically between their seed and A rounds, sometimes between their A and B rounds, who need the type of capacity building and organizational support that will allow them to dig in, have further proof of concept, and raise further capital. We've had over 170 companies go through the accelerator, and they've attracted more than $7 billion on follow-on investment. In addition to that, we have our own funding practice around companies that are leaning into the new green economy and the transition economy. But then we also have a philanthropic practice that focuses on environmental justice and local communities who need to have perhaps a bridge between the state or federal policies that don't often reach local communities, and who are the ones most impacted by the toxicity of their communities' air, water, and soil, and also are having deleterious health effects as a result of it. So we have a full kind of holistic focus around what does the changing climate mean for individuals everywhere.
When Steve became ill, eventually he decided to step back a bit. Did you talk very much about him in those days, about philanthropy?
Having resources and information and knowledge available and accessible to people was for him the most important thing.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
The first time you connected your GoDaddy website and your store was also the first time you realized.
Well, we can do anything. Cheesecake cookies? The Chookie!
Manage all your sales from one place with a partner that always puts you first. Start today at GoDaddy.com.
That knows your business, grows your business. BMO.
We really need to get that life insurance.
Introducing Evie for Ethos. In just 10 minutes, Ethos can help you protect your family's future for as little as $10 a month. Just answer a few health questions and get a quote in seconds at ethoslife.com.
Let's talk about your youth, your teenage years, and where you spent them. You grew up in upstate
New Jersey.
New Jersey.
My father died in a plane crash when I was 3.
He was a Marine?
He was a military pilot. And this was during inactive duty. He was training other pilots, and he died during this training session. And my mother was 29 years old at the time, with 4 children under the age of 6. And she had been a history high school teacher before she had children. And what she ended up doing within about 6 months was starting a nursery school. It was a really smart pivot for her. She had some family and friends supporting her, but she needed to also take care of her children and support us as a family.
So you went to college at University of Pennsylvania at Wharton. Why did you pick Wharton? It's a great school, but were you interested in business at that time?
Well, I started at University of Pennsylvania as pre-med, and I had in my mind that I was going to be a doctor. And so I, in addition to work study and doing my schoolwork and doing waitressing on the side for pocket money, I also volunteered at the hospital of the University of Pennsylvania at HUP. And the doctors there were really generous with me and allowed me to scrub in on surgeries, and I was in labor and delivery, and I had all sorts of jobs. And what I noticed, however, was the degree of commitment that is required and the narrowing that must happen to be great at that discipline. And so I questioned whether that was the right field for me to pursue. At the same time, in my work-study job, I was working for Penn student agencies. And a few months in, I had an idea for an agency. So I proposed it to the man who was running it. He was a Wharton grad student. And he told me to go write a business plan. He said, it's a good idea, but you need to write a business plan. So I wrote up a business plan for what we called Parent Services Agency, which was to market to parents the ability to send birthday cakes and care packages to students while they were going through midterms and finals, and obviously for all their birthdays. And the business ended up flourishing, and we added more and more services. What I didn't count on was, of course, we were working around the clock during midterms and finals on our business. But it gave me that bug. I didn't know about this, the field of entrepreneurism. And so I became an entrepreneur when I was at Penn, and I loved it. And so perhaps sophomore year, I stayed at the College of Arts and Sciences, but then I added in a degree at Wharton. So I ended up getting both degrees.
Right, so you got your degrees, and then what did you do after you graduated?
I had to answer the need to pay off significant student loans. So I ended up